This is opening the open session of the Investment Committee. And first order of business is roll call, please. Ms. Hopper.
Teresa Taylor,
Here.
Rob Fechner,
Good morning.
Frank Ruffino for Fiona Ma,
Present.
Lisa Middleton,
Present.
David Miller,
Here.
Elena Ortega,
Here.
Jose Luis Pacheco,
Present.
Ramon Rubalcaba,
Excused.
Shonda Wesley,
Here.
Betty Yee.
Here.
Madam President, I have all in attendance with Ramon Rubalcaba being excused.
Thank you, Ms. Hopper. Our next order of business is the election of the chair and the vice chair. Oh, Mr. Fechner, go ahead. Oh, I'm taking nominations. I know what you're doing. I'm taking nominations for the chair of investments.
Thank you very much. I'd be honored to nominate David Miller for chair of the investment committee.
All right, we have David Miller has been nominated for chair of the investment committee. Are there any other nominations? Any other nominations? Any other nominations? Okay, seeing no other requests for nominations, I'd like to have someone make a motion for David Miller as chair by acclamation.
I'd like to make that motion. Jose Luis.
Okay, it's been made by Jose Luis. I need a second.
Second.
Seconded by Ms. Middleton. And then Ms. Hopper, can you call roll, please?
Rob Fechner,
Aye.
Frank Ruffino for Fiona Ma,
Aye.
Lisa Middleton,
Aye.
David Miller,
Aye.
Elena Ortega,
Aye.
Jose Luis Pacheco,
Aye.
Ramon Rubalcaba,
Excused.
Shonda Wesley,
Aye.
Betty Yee.
Aye.
Madam President, I have a motion being made by Jose Luis Pacheco, seconded by Lisa Middleton for the election of the chair of the investment committee, David Miller.
Thank you. Congratulations, Mr. Miller. And here's your virtual gavel. You are now in charge of investment committee.
Thank you very much. I appreciate everyone's support. And that brings us to the election of the vice chair. So I will call for nominations.
I got my hands raised.
There you go, Mr. Ruffino.
Thank you and congratulations, Mr. Chair. It's our pleasure to nominate Rob Fechner as the vice chair of the investment committee.
Okay, I will second that nomination. Are there any other nominations? Any other nominations? Any other nominations? Seeing none, I'll call for a motion. Would you like to put forth a motion to that effect, Mr. Ruffino?
Yes.
Okay, I will second that motion and we'll take a roll call vote. Ms. Hopper.
Rob Fechner,
Aye.
Frank Ruffino for Fiona Ma,
Aye.
Lisa Middleton,
Aye.
Teresa Taylor,
Aye.
Elena Ortega,
Aye.
Jose Luis Pacheco,
Aye.
Ramon Rubalcaba,
Excused.
Shonda Wesley,
Aye.
Betty Yee.
Aye.
Mr.
Okay.
Chair, I show all ayes with the excused for Ramon Rubalcaba. Motion being made by Frank Ruffino for Fiona Ma, seconded by David Miller for the election of the vice chair of the investment committee, Rob Fechner.
Great, thank you. Congratulations, Rob, and I'm certainly happy to have you on board as the vice chair to help me along. So with that, we'll move to the item 3, approval of the February 15th, 2022 Investment Committee timed agenda. Do I have a motion?
Move approval.
Moved by Ms.
Second.
Taylor, seconded by, who was that? Mr.
Second.
Rufino.
Okay,
I'm sorry, Mr.
Discussion.
Chair, who seconded that motion?
Mr. Rufino.
Okay, thank you.
So I'll call for the question.
Rob Fechner,
Aye.
Frank Rufino for Fiona Ma,
Aye.
Lisa Middleton,
Aye.
Teresa Taylor,
Aye.
Moreno Ortega,
Aye.
Jose Luis Pacheco,
Aye.
Ramon Rubicava. Excused. Sean Wesley,
Aye.
Betty Yee.
Aye.
Mr. Chair, I have a motion being made by Teresa Taylor, seconded by Frank Rufino for Fiona Ma. All ayes in the, on the agenda item 3, approval of the February 15th Investment Committee timed agenda.
Okay, the motion is approved. Brings us to item 4, the executive report from our interim chief investment officer. And so for that, I'll ask Mr. Bienvenu to take the floor.
All right. Good morning, Mr. Chair, members of the Investment Committee. Congratulations, Mr. Chair, on your nomination as chair of this committee.
Thank you.
So normally I would discuss our portfolio performance and positioning as part of this opening report, but we have our semi-annual trust level reviews scheduled for this meeting, so we can take that topic up in more detail in agenda items 7A and 7B. So given that we do have the board meeting following this committee, I'll keep my comments somewhat brief and just give an overview of what's before us today. We're going to lead off with obviously the committee's routine consent items, and from there, then we'll move on to 3 information items that we have on our agenda. First, your general pension consultant Wilshire and your private asset consultant Makita will provide their semi-annual independent trust level reviews, including coverage of market conditions and portfolio performance. From there, Lauren Rossborough Watt will join Arnie and me to present you with the investment office's internally developed trust level review, where we'll cover portfolio performance and risk, we'll cover an operational update, and then economic conditions. And finally, we'll be joined by Samiso Nazima, our MID, Managing Investment Director for Global Equity, and he'll be giving an update on proxy voting and corporate engagement activities. This item, of course, is presented annually just ahead of the proxy season to give the investment committee a preview of the sustainability topics, which we'll be focusing on during the upcoming proxy season here in 2022, but then also sharing the outcomes of the 2021 proxy season. And that concludes my opening remarks, Mr. Chair. And with that, I'll turn it back to you to take us through the agenda.
Great, thank you very much. And I'm sure we're all really looking forward to the reports on the fine work of the team. So next item is our action consent items. What's the pleasure of the committee?
Move approval.
Moved by
Can we-
Mr. Fechner, seconded by Ms. Taylor.
Yes, but Mr. Pacheco?
Yes,
Wanna-
may we separate the items because of the minutes? I'm sorry.
Okay. We'll-
Thank you.
we'll-
Thank you, Chair. Thank you, Mr.
Okay,
Hilder.
Ms. Hopper, then we'll call the roll for 5A.
They're both, I'm sorry, they're both for November. So we don't really need to separate it.
Thank you for the clarification. Thank you.
Oh, okay. So we'll call the roll.
Okay, Mr. Chair, can you reconfirm the motions on those, please?
It was moved by Mr. Fechner, I believe, and seconded by Ms. Taylor.
Thank you. We're taking both items together.
Yes, I believe so.
Okay, Rob Fechner,
Aye.
Frank Rufino for Fiona Ma,
Aye.
Lisa Middleton,
Aye.
Teresa Taylor,
Aye.
Moreno Ortega,
Aye.
Jose Luis Pacheco,
Abstain.
thank you. Ramon Rubicava,
Excused.
Shonda Wesley,
Aye.
Betty Yee.
Aye.
Mr. Chair, I have all ayes, 1 abstention made by Jose Luis Pacheco. Motion being made by Rob Fechner, seconded by Teresa Taylor for agenda items 5A and 5B.
Okay, thank you, Ms. Hopper. The motion carries. On to our information consent items. I have no request to pull either of those. So with that, we'll move on to our information agenda items, and we'll go to our CalPERS trust level review and our fine consultants from Wilshire.
Yes, thank you, Mr. Chair. And can I ask that Tom Todt and Steve McCourt be brought forward into the presenter's queue, please? And this is the first trust level review of 2022. And the committee may recall that your staff and your board consultants alternate who presents first, with the consultants going first for the calendar year results in February or March, and then staff taking the lead with the fiscal year results in September. So this is the consultant's turn to go first. So with that, I'll turn it over to Tom Todt to lead us off and take us through Wilshire's portion of the presentation. Tom, over to you.
Thanks, Dan. Good morning, Tom Todt with Wilshire Advisors. It's our pleasure to start off the trust level performance discussion this morning, and we'll start with some comments on the market, move through Wilshire's forward-looking asset class expectations, and then we'll wrap up with some comments on the portfolio's performance with a particular focus on the calendar year 2021. Inflation has become a focal point for most investors, consumers, and central bankers, as inflation, which had been dismissed by many, including the Federal Reserve, as being transitory only 6 or so months ago, is now viewed as potentially stickier. And if we look at page 21 of our deck, you can see that illustrated with CPI up 7%. Oh, I'm sorry, page 2 of our deck, page 21 of the PDF. I'll refer to our deck numbers from now on. Thanks very much. So you can see on the upper left-hand side, the consumer price index up 7%. And in fact, that is actually one reading out of date. Just last week, we received a more updated one with a reading that was even higher at 7.5%. And you can really see, inflation in many places. The producer price index up over 12%. Home prices, which don't flow directly into the inflation calculation, but can be a leading indicator, up over 18%. And commodities up north of 27%. And although consensus growth and inflation forecasts still point to a mean reversion back towards pre-COVID levels over time, central bank guidance is increasingly reflecting concern that this could prove persistent. And accordingly, we've started to see financial conditions tighten, albeit admittedly from very accommodative levels. If we move forward to page 3, economic growth has recovered strongly, but employment has not kept pace and remains well below pandemic levels, pre-pandemic levels. On the next slide, page 4, we can see that there is persistent friction in the employment market. And in the upper left-hand side, you can see that job openings are elevated relative to the total unemployed, which implies a shortage of labor that has led to increased wage inflation, and that can play through the measured CPI increases. Employers can continue to struggle to get employees back to work, and the employment market is increasingly competitive. On the next slide, you can see that the labor force participation rate on the left-hand side has retraced less than half of the decline compared to the pre-pandemic time period. And it's likely that some of that decline is permanent due to accelerated retirements from some workers, but rising wages and changes in COVID case counts could presage some improvement in that participation rate. And you can see on the right-hand side the upward trajectory in average hourly earnings. If we jump ahead to page 7, Fortunately, most major economies are forecast to deliver strong levels of real GDP growth in 2022, although at lower rates than we saw in 2021 for the most part. Furthermore, particularly in the US, strong household balance sheets and higher wages are supportive of personal consumption, even in the face of higher inflation. And while the global economy continues to grapple with those inflationary pressures, it's also important to recognize that short-term cyclical factors have meaningfully contributed to these pressures, and these include supply chain disruptions, labor shortages, and those persistently high COVID-19 case rates. Unfortunately, those same factors have begun to weigh on sentiment, most notably in the services sector, as service PMIs have been softening across many major developed markets, while still signaling expansion. We did see, fortunately, that fourth quarter US GDP growth came in higher than expectations due to strong personal consumption, particularly of services, as well as strong private domestic investment. On page 8, and this gets into the current market environment, as well as then our outlook. We've labeled 2022 as a year of transition. And the question that we ask is simply, if much of the rally that we've seen in capital markets has been due to very accommodative policy and fiscal support, when that support is withdrawn, what should we expect from markets? And the decline in equity and fixed income markets and an increase in both equity and interest rate volatility to start 2022 is reflective of a market that's increasingly focused on monetary policy, with hawkish guidance coming from global central banks as they look to contain inflation as economic growth recovers. And in fact, as we look forward, the futures market for short-term interest rates are pricing in nearly 5 interest rate increases in 2022, which would imply a policy rate at the end of the year of approximately 1.25%. And that also includes an increased possibility of a 50 basis point hike in March, which would be the first time a 50 basis point increase in interest rates has occurred going back to, I believe, the early 2000s. 2022 has also seen market volatility rise in response to other factors, including geopolitical concerns over tensions in Ukraine with Russia, and the potential rolling economic impact of different COVID variants. Now, that being said, we believe the Fed's and other central banks' hawkish tone regarding monetary policy is warranted. And looking at their statements, they'll remain data dependent and nimble in implementation. We think that is appropriate. We think as we sit now with rising rates, we're seeing a necessary repricing of US bonds as real yields have been distorted by central bank actions. And despite this rise in recent yields, nominal bonds remain mispriced relative to inflation and economic growth. And for example, today, real yields sit at negative 60 basis points, while the longer term average of real yields has been just below 1% positive over periods of time where we've seen far lower economic growth relative to inflation consensus expectations for 2022. On page 9, we've provided a summary of Wilshire's forward-looking asset class expectations. And these asset class expectations are one of the building blocks for asset allocation discussions that we have with clients. And they incorporate both the impact of shifting monetary policy, inflation expectations, as well as equity market valuations. And just to hit on a couple of highlights here, rising interest rates, while a headwind for fixed income returns over the shorter term time period, actually do increase our return expectation for core fixed income over the full 10-year time horizon. That going in yield at a higher level is one of the the big determinants of the total return expected over that 10-year horizon. A simple way to think about it is you have some price impact at the beginning of the period, but the reinvestment over the full period actually moderately increases the total return. We do expect rising inflation to be beneficial for real assets such as real estate, and I'll have a few comments on that a bit later. And then finally, from a summary perspective, elevated equity valuations, particularly in the US, have reduced the expected risk premium for equities relative to bonds from 3.7% at the start of 2021 to its current level at 2.5%. If we flip to the next page 10, we've talked a bit about the increase in market expectations for short-term interest rates as measured by the Fed funds rate. So you can see sort of the pace of increase there and the shifting yield curve on the upper right-hand side relative to where we were a year ago, which is the red line there on the upper right-hand side. You can see a shift across the curve most recently. And then if you compare just last quarter to this quarter, you can see particularly at the short end, 0 to 5 years, a meaningful increase in the yield curve from the current period relative to just 1 quarter ago. On the bottom right-hand side, that gives you a sense for where credit spreads sit. And you can see that they remain tight by historical standards, almost no matter where you look, whether it be investment grade or below investment grade securities. Turning to page 11 and equity markets. This provides some detail on the models that we utilize to forecast equity market returns. In the upper right-hand side, you can see the headwind that we expect from valuations, which are built into one of those models, which we call the income growth and valuation, or IGV model. You can see that all of the components here, whether it's dividends, inflation, or real EPS growth, are projected to be lower than historical experience. But the real standout here is that valuation, with changes in the price to earnings ratio forecast to normalize and detract 3.5% from the expectation. As you look at the other components there, you can see we also utilize a dividend discount model, which is a slower moving model for forecasting equity returns, as well as a cyclically adjusted price to earnings ratio as another model. And all of that comes together to forecast an expected return for global equities at just over 5%. With US equities forecasted to return 4.5% and non-US equities at 5.5%, giving differences in relative valuation. Now, strategically, and this is critical as we start to talk about the PERF portfolio and the discussions that we've had around asset allocation, we flip to page 12. Investors really need to balance the impact of higher interest rates against earnings growth and a relatively strong global economy, particularly as we look at the muted return expectations on this slide. And simply going back to the early 80s, you can see that across asset classes, expected returns have declined materially. Now, using those asset class expectations on page 13, we show the PERF portfolio's expected return over multiple horizons, over both a 10 and 30-year horizon. Please keep in mind that these are based on the previous asset allocation targets, and they'll be updated as we move through the implementation of the targets approved by the board in November. But with this snapshot, over the 10-year period, expected returns hover around 5%, while over the long-term 30-year horizon, returns are expected to be higher at around 6.5% to 6.6%. So as the board thinks about strategic asset allocation, I thought this would be an opportune time to just make a couple of points. Given the uncertainty we've discussed around the markets and the economy, Diversification remains a critical building block for portfolio construction. The introduction of leverage in the new asset allocation is explicitly meant to maintain a level of diversification while allowing the portfolio to meet its expected return targets. This diversification is also evident in a target allocation for sovereign emerging market debt. The increase in the real asset target could benefit from higher inflation expectations as rents for the underlying investments adjust. And in addition, as we think about the investments in private debt, many of those investments are structured with floating interest rates. And so they don't have the same interest rate sensitivity as other parts of the fixed income universe. So as we see rising interest rates, that actually should somewhat cushion the impact to the portfolio within the private debt allocation. With a challenging return environment in equity markets, increasing private equity provides an opportunity to drive higher portfolio returns, albeit with higher expected levels of risk. And that was built into the modeling, which was part of the asset allocation discussion. Implementation is going to be critical in terms of driving success there, with consistent deployment of capital being one of the most important facets, something we've talked about with the board in the past. Before we move on to performance, I wanted to see if there are any questions from the board on either the market or forward-looking expectations.
Okay, I'm not seeing any requests in the chat, and I can only see a few. Oh, I see, it looks like Controller Yi has a question.
Thank you, Mr. Chairman. Congratulations on your assuming the chairship. I did have one question, and I don't know if Tom, I may have missed it, and that is, has the market already started pricing in the expected Fed increases?
Ms. Yi, yes, they have.
Okay.
The market is starting to price that in. That's why you're seeing primarily the shifting yield curve.
Okay. Okay. Got it. Thank you.
And in fact, that's, I think, one of the key reasons you've seen the 10-year Treasury move up to about 2%, which is the first time it's been there since 2019.
Got it. Okay. Thank you.
Mm-hmm.
Okay, I have Ms. Taylor.
Yes, thank you, Mr. Miller, and congratulations on your chairmanship. Mr. Toth, I had a couple of questions. I think it was back on, hold on, slide 2 and 5. Let's start with slide 2. So I was wondering, are we pricing in, I mean, are we looking at the fact that inflation could be also impacted by how the supply chain is having problems because of climate disruptions? So I recently read something on how lumber is gone just exponentially expensive, among other things. But is this part of inflation, inflationary pressures as well? Are you guys looking at that? And are we, as a board and as CalPERS, making sure that we're pricing that in because of climate disruptions?
Ms. Taylor, that is a great question. I think broadly speaking, yes, you're incorporating that into the analysis, and that's undoubtedly a risk associated that could impact inflation going forward. So that is something that we're cognizant of. And when we think about climate change and the impacts to the portfolio, that's the lens that we utilize. It's one of risk management and trying to incorporate that into our analysis. So short answer to your question is yes, that is incorporated here. It's hard to tease out the specific impacts of, for example, the bottom right-hand side there, the impact that how much of that 27% increase
Right.
is from those what you brought up, but it's undoubtedly a risk, and it's something we want to be cognizant of from a portfolio standpoint.
And then sadly, I read another article that was calling out the fact that larger corporations are using this time frame to artificially drive their prices up and hiding it within the inflation index that's coming, and thereby driving inflation up. So, and for the life of me, I can't find that article now, but I believe one of them was General Mills. I know as an organization, we can't do anything about that, but what would you say to that, and how does that impact us? Is that just normal?
I think it's important to keep in mind that generally speaking, these organizations are working in a competitive environment, and they don't really have the ability to raise prices without reason. Otherwise, they would do that even when there wasn't supply chain disruptions. So it's certainly rising prices. I mean, by definition, goes into that CPI calculation. But I'd be hard pressed to tease out that as being uncompetitive pricing and try to attribute that to these figures.
Yeah, that's a shame, because these there were quotes from CEOs saying, "Yeah, we're taking advantage of this on purpose." So that's really hurtful, and I think that's something we also need to focus on in the future, maybe in proxy voting. I don't know. And then on slide 5, we were talking about the labor force and the labor dynamics, and I just want to I think that we need to really take into account the impacts of COVID on our workers, right? So people, I think you said something about retirement, early retirements, et cetera, but also I think people are out of work because of long COVID. I think a lot of folks aren't coming back to work because they're afraid to get sick. And there's a lot of, dropping of policies that we had at the beginning of the pandemic. And so now there's no sick leave for folks. And the conditions are strained. And then maybe we should pay better. Maybe this is what the problem is. A lot of these strained labor force is always in our service industry, and those are the lower paid jobs. So I think that's something we need to take into account, that our workers, need sick leave. And I wouldn't want to, if I had to go back into work during COVID, I don't know that I'd want to either.
Ms. Taylor, absolutely fair points. And the right-hand side of the chart on the right shows that you are seeing wage pressures, and then we can have a discussion of whether it's sufficient or not. And that's a market clearing exercise. But you're undoubtedly right that it's not just retirements driving this labor force participation. It is the caring for sick relatives, childcare, any number of other issues impacting the labor force, and that's why I would expect this participation number to continue to grind higher. I don't know that it's going to get back to that pre-pandemic level because of the retirement dynamic, but I do think it's going to continue to improve.
Oh, you're muted, Teresa.
I just want to also bring up the fact that this country doesn't have a very good sick leave policy for, Americans, especially in the service industry. It's just not there. And I think that we need to continue to work with folks as an organization, whether that's through rulemaking or whatever, to make sure our workers are covered when they're sick. Because part of the reason, and I'm hearing it at my own work site, right? So I'm hearing a lot of people who are like, I don't want to go back into work. I don't want to be sick. I've already had COVID. So, and if they don't, and some of these workers are new workers, so they don't have any sick leave saved up. Imagine what it's like at McDonald's or someplace like that, where there is no sick leave policy. So I think that's something that as we move forward as an organization, we need to, that's part of our S and our ESG. And that is putting strain on the labor force right now as well. but thank you.
Yeah, certainly the question of whether it's really a labor shortage or whether it's a wage shortage, especially in the service sector, is a worthy question. So next I had Ms. Middleton.
Mr. Chair, thank you. And again, congratulations. Tom, a couple of questions. And I'm looking at slide 13, the one that you finished with. Yeah, thank you. The target allocation, the actual allocation, if I heard you correctly, that you have here is based on the ALM previous to November of last year and does not incorporate yet the changes that were authorized in November. Is that correct?
That is correct.
And have you taken and done a similar chart that would incorporate those changes from last November?
We have looked at those figures. Actually, when we were going through the asset liability management process, one of the checks that we utilized as your independent consultant was to model those portfolios using Wilshire's expectations. I don't have those figures at the tip of my fingers right now, but I can certainly provide them to the board. They would generally be that you would see them move higher. But I don't want to just hazard a guess here without pulling those figures up.
Okay, then I won't ask you to guess, but I would appreciate seeing those.
I will follow up with those, absolutely.
So without dating myself too much, for those of us in my generation, and this is a much broader question, we spent the first 25, 30 years of our adult lives with inflation being rather constant. And now we've enjoyed almost 2 decades with very little to no inflation. I find myself struggling to believe that this turn in inflation is simply a temporary blip brought on by a combination of COVID and the supply chain issues. But what kinds of leading indicators would you suggest that we should be looking at as we try to determine whether or not we're going to be measuring these inflationary pressures that we're seeing now in months, years, or decades?
Great question, Ms. Middleton. I think the producer price index as an input to the consumer is a good leading indicator. And then the home price index as well. This gets a little bit wonky, so please excuse me, but the input into CPI is actually not home prices themselves. It's something called owner's equivalent rent. And it's a statistic that's meant to capture the increase in the value of the service that your home provides to you as a consumer. And that's not directly measured by home prices. But what economists have found is that home prices tend to be a leading indicator for that owner's equivalent rent. And it flows through at a 12 to 18 to 24 month kind of lead. And given where home prices are, as we saw earlier in the presentation, home price increases, and I'm sure all of us in our individual lives have seen this just chatting with colleagues and friends, they're elevated, and they're elevated really broadly across the nation. And that's likely to flow through the owner's equivalent rent as we move forward. So I think those are 2 leading indicators you could watch for deciding on the stickiness of inflation.
Home prices are certainly something that almost all of us notice on a very regular basis, so thank you for that. But I do really believe this is the fundamental question for us as an organization over the next year and moving forward is how long are we going to have the kind of inflation that we're looking at today? Thank you.
Thank you. And next I have Mr. Ruffino.
Thank you, Mr. Chair. And thank you, Tom, for the presentation. I got a couple questions. One, first one relating to the geopolitical events, and you alluded to, you briefly mentioned, i.e., the prospect of Russia invading Ukraine. Although this morning there was some hopeful news that he's starting to pull some of the troops and maybe wants to give diplomacy a chance. That remains to be seen. But however, if the US theoretically were to levy sanction against Russia or prevent Russian banks from doing business with the US financial systems, what would they do to global trade and what effect would that have on our investments?
Mr. Rufino, thank you for the question, and that's a challenging one. The short-term impact would undoubtedly be higher levels of market volatility and a general, I'll call it risk-off sentiment from the market, and you tend to see this around big geopolitical events historically. I would not expect this to be any different. I would caution the board that trying to manage a portfolio the size of the PERF using that type of outlook and anticipating that is a challenge. And so thinking strategically, i.e. over a longer term time horizon, I think is going to be really important. And using those dislocations as opportunities to rebalance as necessary for the total portfolio. That's the best way to manage through those dislocations, because as you pointed out, you get very quick sell-offs when geopolitical tensions increase. But when we get reports like we did this morning that it seems to be lessening, you get rallies in the market, and trying to guess which one of those is going to occur and over what time frame. We don't think that's a very prudent course of action. So something certainly that should be kept in mind and monitored and potentially utilized to rebalance, but I don't think a shift in strategy is warranted based on those concerns. Now, obviously, that needs to be continually evaluated as we move through it. And to the extent that we were to see an escalation in tensions, that would be a challenge. And I also think it's important to keep in mind as we think about portfolio construction, there are segments in the portfolio which are meant to cushion those drawdowns. So for example, the factor weighted exposure within the equity portfolio, the dedicated treasury exposure, which tends to cushion risk market drawdowns as another example of trying to cushion the portfolio in the event of these risk off type of markets. We would expect that to be beneficial in this instance, as it has been historically.
Thank you for that. I have another question for you as well. Looking at the page 8, which is the year of transition, you named that page.
Mm-hmm.
And so given the volatility seen at the start of 2022, does that change your view on the recently adopted asset allocation?
The short answer is no. I think the discussion around ALM incorporated a certain level of uncertainty or volatility within the markets. And so the decisions that were made were predicated on some expectation of variability. And we're living through the downside variability now. And so I don't think it should drive a shift in strategic positioning going forward. So that's number one. And then number two comes down to implementation of that strategic target, which we are going to be very judicious about. And so it's not turning a switch to the extent we can mitigate the market timing impact of shifting the asset allocation. So that's going to be, it is and will continue to be a very thoughtful process, and we'll provide continued updates for the board around that as we move through it.
Excellent. Thank you. Thank you, Mr. Chair.
Okay, thank you. And next we have Ms. Ortega.
Thank you, Mr. Chair. I just wanted to return back to the sick leave conversation. And while the sick leave benefit that the federal government had provided prior has expired, the governor did sign a bill last week on February 9th, SB 114, that provides workers in California with up to 80 hours of additional supplemental paid sick leave. So that's good news for California's workers.
Yeah, it certainly is good news, and certainly appreciate that from the governor's leadership. Okay, next, it looks like I have, say, Luis Pacheco.
Thank you. Thank you, Chair Miller, and congratulations again on your chairmanship on the committee here. So my question is regarding the interest rates, and as Mrs. Middleton had pointed out with leading indicators. It's my understanding that Chairman Powell from the Federal Reserve has indicated that there will be some increases in interest rates in this forthcoming year. Will that affect, as interest rates go up, will that affect housing prices? And in turn, if that's the case, will it decelerate the prices, or do you suspect that, or do nothing at all? I just want to have a better, clear understanding. And how will we measure that with the, will we use the owner equivalent index that you had mentioned earlier? Thank you.
Mr. Pacheco, a great question. The short answer is my expectation with rising interest rates is that would slow price appreciation in the housing market for the simple fact that it makes borrowing for housing more expensive. And that's obviously a budgeting exercise for any individual, but all else equal at a high level, higher interest rates are likely to slow rising prices in the housing market. And that's, it's not aimed at housing, but broadly speaking for the economy, that's their goal, is to tame inflation by increasing interest rates. And that flows through so many facets of the economy, from borrowing for houses, corporate borrowing, credit cards, what have you. All of those interest rate levels are interconnected.
Thank you for that answer. Thank you.
Okay, and it looks like I have another question from Ms. Taylor.
Sorry about that. And thank you, Mr. Chair. Tom, when you were explaining to Ms. Middleton the how the high price of housing prices fit into inflation, what kind of made my brain go, but what? Because housing prices have been exponentially growing for years. So why didn't that impact and cause inflation earlier? Because housing prices, not just in California, but all over the country, have really skyrocketed. Yeah, in the pandemic, I think maybe some of it went a little higher, but I've been reading about the increase of housing prices year over year. I think, gosh, before the pandemic started, there was a 21% increase in housing prices just here in Sacramento. So how come that didn't impact inflation before?
Ms. Taylor, I think you highlight a really important part about the intricacies or the interconnectedness of the economy. So I would argue that the increase in housing likely did have inflationary impacts through the owner's equivalent rent, but it was offset by improvements in technology, which drove down other prices. Energy prices, which fell, pushes down inflation. Improvements in agriculture push down some food prices. And the reason that we're currently seeing a spike is because you're actually seeing a broad-based increase in inflation. It's not just housing, that's a component, but it's also in energy, it's also in foodstuffs, you've probably heard of used cars, and supply chain issues causing increases in consumer goods, all of which during all quote unquote normal times would somewhat offset each other. And then I think we're also in a period of time, this is looking over maybe a longer term time frame, coming out of the global financial crisis and the housing bust, construction of homes slowed down materially. And so now we're at a point in time where demand for housing is outpacing supply, which somewhat of a different dynamic than we've seen, previous to the housing bust, where construction of new housing was moving ahead quite rapidly. Builders, understandably, I think, have been a little bit more hesitant, given potentially they were burned in the 2008, 2009, 2010 time period, post credit crisis, so that there's that supply demand mismatch as well.
Okay, I get that. I appreciate that. And then I just wanted to bring up that I think it was when I was talking about companies pricing, taking advantage of inflation. One of them was, as I recall, Procter and Gamble, and they're making a huge profit but still increasing prices and hiding it in inflation. And I think that is something that I don't know what we can do about that, but it just seems really, really wrong. And part of it is because there isn't a lot of competition. I mean, Procter and Gamble owns everything, right? So, and I think it's important that however we deal with this, whether it's through proxy voting or whatever, that these are pressures on the American people that are causing inflationary issues and hurting lots of folks along with it. So, but I remembered who it was, so I just wanted to let you guys know.
I appreciate that.
Thank you. I'm not seeing any more requests to speak. If anyone does want to, and I can't see them in my limited little screen, just speak up now. Okay, I think that's it for questions from the board, and really appreciate the comprehensive report, and really look forward
Mr. Chair, we do have one final section I wanted to touch on, which is actual performance for the PERF. If I may.
Yes, please do.
Great. Let's flip forward to page 16. And then I will turn it over to Makita for their comments. So a couple things to highlight as we look at performance here. Performance for the year was quite strong, up 13.3%, with the quarter's performance, so very strong fourth quarter, up 4.7%. And both returns handily outpaced both the policy benchmark and the actuarial rate, so outperforming by 1.2% relative to policy over the year. The largest driver of returns in 2021 was private equity, which was up over 39% versus the benchmark return of 31.4%. The public equity allocation, which is the largest allocation in the PERF, was also up meaningfully, almost 18%. Real assets returned 15.8%, outpacing its benchmark return of 13.4%. And I also wanted to note the performance of opportunistic strategies, about 2/3 of the way down the page, which now has 1 year's worth of performance, and was up 15.2%. Makita will have some more comments on the private equity and private real asset portfolios, so I won't belabor those points. But if we turn to attribution, the next couple of pages cover it over different time frames. I'll actually ask that we turn to page 19, which is the 1-year attribution. For the benefit of the new members, performance attribution is meant to capture the relative performance impact of the underlying strategies within the portfolio. It takes into account both the relative weights over and underweights of the portfolio versus their target, as well as the returns of those strategies versus the benchmark returns. And so that's what we're looking to dive into here, is which particular parts of the portfolio contributed to the 1.2% in outperformance and which were a drag. As you look at kind of the far right-hand side of that page, that is the total relative performance attribution for the various segments. So at the upper right-hand side, you see 0.15. That indicates that public equity in aggregate drove 15 basis points of outperformance relative to the policy benchmark. So nice, strong performance from private equity. As you move down the table, private equity contributed 64 basis points of return, which was the best relative contributor to performance across the portfolio. I want the board to keep in mind that we should expect a reasonably high level of variability within the attribution for private markets, as the valuations tend to move more slowly than we see in public equity, and the capital deployment and distributions are less predictable. And all of that is going to drive mismatches between the portfolio and the benchmark, which has an impact on that variability. So for calendar 2021, very strong positive performance from that portion of the portfolio. Turning to fixed income, it was the biggest drag on absolute portfolio performance. It was down 1.4% in absolute terms, but as you can see from the attribution in aggregate, it did add 7 basis points of relative return, driven in many ways by both strong issue selection in the spread segment, as well as an intra-segment underweight to treasuries and overweight to higher yielding spread sectors, which over time were beneficial to the fund. So moving further down, real assets contributed 25 basis points of active performance. It was another large contributor. And again, Makita will have more comments on both private equity and real assets here in just a second. And then the last point I wanted to make here is at almost the bottom of the page there, the trust level financing line, which added 39 basis points of relative performance. And that might seem counterintuitive because trust level financing does come at a cost. It's borrowing. So I wanted to point out for the board that this is actually capturing the impact of utilizing that capital to invest in other assets that outperform the cost of financing. So that borrowing in this case was beneficial to performance to the tune of 39 basis points. And if you were to sum up all of those numbers in that total column, that's where you would get to that 1.2% excess return relative to the benchmark. So the broad takeaway here, just to wrap up, and I'll turn it over to your private consultant. Very strong absolute performance for 2021 and strong relative performance across the portfolio. So I'll stop there and see if there are any questions on performance, or we can move on to Makita's comments.
Hey, thanks for that very clear and comprehensive wrap up. I really appreciate how easily understandable you made all this complexity for us. So it looks like I have Ms. Taylor with a question. Oh, no, just a...
My bad, sorry.
Oh, no worries. I'm not seeing other hands or questions in the chat. If I can't see you, because I can only see a couple of you at a time, just shout out. Okay, I think that does it. Thank you, Mr. Toth. We'll move to Makita. I believe Mr. McCourt.
Great. Thank you, Mr. Miller. And congratulations to you and Mr. Fechner on the leadership positions for this year. I won't be reviewing in detail the broader economic and capital market outlook as I go through our reports, but just to summarize, these reports that we're going to be going through are as of December 31st. And a few weeks later, we found ourselves in potentially a different type of environment. So I'd say that largely because these are three quite positive reports that we have the pleasure of presenting to you today. We are your private markets advisor, and we have three trust level reviews that we've submitted. Attachment 3 is our private equity review. Attachment 4 to item 7 is the real estate review, and attachment 5 is our infrastructure review. In the interest of time, I'm going to summarize each of these in a few minutes each, and then open it up for questions after getting through each of them, if that's okay with you, Mr. Miller.
Yep, sounds good.
Great. So starting on private equity, the first thing I want to highlight is related to this and the real assets asset class. The most important dynamic with these asset classes relates to the new strategic asset allocation, which will require these asset classes to scale up quite considerably. In the case of private equity, the target allocation with the new asset allocation is increasing from 8% to 13%, and has your investment team has discussed with you, that's going to require significant expansion in the capital that's deployed annually into the private equity space. As of December 31st, the net asset value of your private equity portfolio was $49 billion. That's an increase of about $6.7 billion from 6 months earlier. And that amount represented just shy of 10% of the total trust fund. As Wilshire noted in their report, private equity had a spectacular year on both relative and absolute basis. Your private equity portfolio returned 39.3%. That was about 8 percentage points above the policy benchmark. We'll repeat what we say almost every 6 months. The benchmarking for both real assets and private equity is not precise. So these relative returns, as you've seen in recent 6-month periods, can move up and down quite quickly. That being said, over longer term periods, private equity has also performed well. Over the trailing 3 years, your portfolio has returned just over 17% per year on average. That's nearly 3% per year higher than the benchmark. And over the prior 5 years, your private equity portfolio has returned 16.5% per year on average. Over the trailing 10 years, 13.9% per year on average. So extraordinary performance from this asset class over the last decade. What was interesting about 2021 as a calendar year within private equity is the rising tide really lifted all boats as you looked into the details of the portfolio. All of the major sectors in which you invested experienced strong gains. Buyout strategies, which are by far the largest component sector of your private equity portfolio, were up 40% for the year. Credit strategies up 27%. Growth strategies up 41%. Opportunistic strategies up 42%, and venture capital strategies up 32%. So very strong performance at the strategy level across the board. Also, across the various vehicles and structures that you currently utilize to gain exposure to the private equity marketplace, all experience strong gains. Customized investment accounts produced aggregate returns of 32.5% for the year. Co-investments returned 36.3% for the year. Fund of funds were up 30.2%. And fund investments, which is the largest vehicle type you have today, up 42%. So really strong performance across structure. And also across geography, returns were quite strong. Most of your portfolios invested in US private equity, and private equity in the US for you was up 40.7% for the year. Private equity in developed markets outside the US were up 40%, and emerging market strategies were up 24.4%. I'll note that in the second half of 2021, your investment team made 34 commitments totaling $7.5 billion. And for the full calendar year, made 58 commitments totaling $12.3 billion. That's a meaningful increase in scale of deployment over 3 to 5 years ago. And that type of scale will be continually necessary to achieve your new targets in private equity. From a policy perspective, your private equity program was invested in compliance with all key policy parameters. So in conclusion on the private equity, really strong year in performance. Staff continues to execute a strategic plan in a very thoughtful and appropriate way. Shifting on to real estate, which is attachment 4 on item 7. Your real estate portfolio was valued at $45.3 billion at the end of 2021. That represented about 82% of your total real assets portfolio and about 9% of your total trust fund. The real assets portfolio also will see an increase in its target allocation related to the new strategic asset allocation. That target will be increased from 13% to 15%. Performance for real estate was quite strong for the year, as like with other asset classes, real estate continued to rebound and improve from the pandemic during the year. For 2021, your real estate assets returned 16.5%, outpacing their benchmark by 3.1 percentage points. Over the trailing 3, 5, and 10 years, your real estate assets returned 7.4%, 6.8%, and 9.6% respectively, over each period outperforming their benchmark. From an attribution perspective, certain sectors of real estate experienced strong appreciation during the year, and the fact that you have a very diversified real estate portfolio meant that you had strong exposure to some of those areas. Your 2 core residential managers, which on a combined basis represented 25% of your core real estate portfolio, posted returns of 16% just for the fourth quarter. Industrial was another sector that experienced very strong returns during the year. And industrial portfolios represent about 29% of your real estate portfolio in aggregate. Your 2 industrial portfolios returned 11.8% and 11.1% for the quarter. When we look at your returns, not just in the core real estate, but in the value added and opportunistic, returns are also positive over all trailing periods. The value added investments over the trailing 1 year were up 12.8% and opportunistic up 10%. From a compliance perspective, your real assets portfolio was invested in compliance with all policy parameters. And just a quick note on the real estate market, largely as there was some conversation about inflation impacts historically and going forward. Perhaps more so than other asset classes, real estate as an asset class has had both strong winners and losers from the pandemic. Counting themselves in the group of the winners include property types like data centers, life sciences, industrial, housing, and properties in suburban locations. Property types that have been more challenged during the pandemic include hospitality, retail, and office in central business districts. So as a asset class, returns have recovered nicely across the real estate spectrum. There has been significant variety in returns, both positive and negative, among the various real estate sectors. But in aggregate, we find that your real assets team is executing the existing strategy strongly in the real estate area and is poised to continue to execute well with the higher target allocation that they've been given with the new strategic allocation. The final report I'll hit on is our infrastructure report, which is attachment 5. At the end of December, your infrastructure portfolio was valued at $9 billion. That was an increase of almost $3 billion from just 6 months ago. This has been a fairly active area for your investment team. As of the end of the year, infrastructure represented 16% of your real assets portfolio and 2% of your total trust fund. Returns for infrastructure continue to be quite strong over both near and long-term periods. For the calendar year ending December 31st, your infrastructure portfolio returned 14.9%. That was 1.6 percentage points above the return of its benchmark. And over the trailing 3, 5, and 10-year periods, your infrastructure portfolio was up 7.1%, 10.1%, and 11% respectively, outperforming the real assets benchmark over each of those time periods. The vast majority, over 90% of your infrastructure portfolio is invested in core properties, which don't include significant economic GDP risk with them. They posted very strong returns during the year. About 60% of your portfolio was invested in the US and about 40% invested outside the US. The US market, much like we saw in other asset classes, produced stronger returns than international markets within infrastructure, though both geographies produced positive returns for the period. As noted, the infrastructure portfolio was invested in compliance with all key policy parameters, and your investment staff continues to execute in the infrastructure space in a way that is aligned with its strategic planning and policies, and performance is reflecting quite favorably today. So with that, I will close, and Mr. Miller, hand it back to you for any questions. And I should note, I also have our resident experts on real estate, infrastructure, and private equity in David Glickman and Steve Hart and Lisa Bacon that are available for questions as well. Thank you.
Okay, thank you for that report. And I do see some hands up for questions, and I'm very encouraged by the strong performance and by the strong execution by our team. And it's really good to hear that validated by our expert consultants. And so we'll move on to first Ms. Taylor.
Yes, thank you, Chair Miller. I wanted to thank you guys too. I and our staff. This is a really excellent report on our commitments, increasing us being consistent, which is what we want to be. And also, you know, just the performance in general. I'm very, very happy with this. I wanted to also thank you, Stephen, for on page 4 of attachment 4, you guys at the very bottom here talked about embracing your responsible contractor policies. And I just want to thank you for, you know, putting that risk in there so that we are, you know, taking care of that risk within the portfolio. And we, you know, as CalPERS is the industry leader in responsible contracting, I thank you very much for making sure that you mentioned that. But I also think it's important that we take these kinds of policies, responsible contractor workforce policies that are risk issues and integrate them across our portfolio and across asset classes. But again, thank you very much for the report, and thank you for getting into a little bit into our responsible contracting here. Thank you.
Okay, thank you. Next, I have Controller Yi.
Thank you, Mr. Chairman. Yeah, so I want to also thank Tom and Steve for the reports this morning. I guess, Steve, to your report on real estate. So I guess the disposition of office buildings is still kind of up in the air, kind of almost in a deadlock situation. But anything that you foresee that could help, that could spur movement either in purchase or sales of these office buildings?
Well, it's an interesting market in that there's certainly a lot of weakness in what has historically been the strongest geographical parts of office, which are the big city centers, of course. Across the whole sector of office, vacancy rates are actually still meaningfully lower than they were during the last 2 recessions in 2008 and 2002. But there's certainly a sense that both tenants and owners haven't quite figured out what office space needs and availability will be for the next decade. So this might be a dynamic Controller Yi that we see unfold more slowly over time. It's certainly, though, the early feedback from the marketplace is that the incremental demand in office space is in suburban areas, and the office in city centers may the demand may continue to languish for a while, but we'll have to see, of course, as the pandemic continues to unfold.
Sure. Okay, thank you. And then I guess to both you and to Tom, do you foresee any type of federal policy that you would expect to help mitigate the increased inflation rates on both companies and consumers? I mean, it's nothing solid yet, but certainly a lot of discussion. But do you foresee anything coming down from the federal government around that?
So maybe I'll start, Tom, and then hand it off to you if you have any comments. Inflation that is caused by supply factors is challenging to do much about because governments don't have significant control over supply chains and the issues that are affecting supply chains. The Federal Reserve's reaction to inflation of increasing interest rates doesn't impact supply in the economy. It has the impact of reducing demand in the economy, which itself will certainly have a downward pressure on prices in the aggregate, but it also has a downward pressure on economic activity in the aggregate. So one has to be quite careful in how they deploy that tool. I'm not aware of significant federal policies, apart from releasing oil from our strategic reserves and things like that that most administrations do when there's price volatility in certain sectors that are really targeted at resolving the supply chain issues at this stage. So my personal take is that inflation will continue to be a challenge at the public policy level because it's mostly, I would say it's mostly, but it's certainly a large part of it is supply chain driven as opposed to demand driven.
Mhm.
And Ms. Yee, I think I would echo a lot of what Steve said. I'm not aware of particular programs. The things that have been done to try to help smooth out the supply chain is an example of where that could help on the margin. But to Steve's point, we'd agree that these are very complex linkages, and there's unlikely one silver bullet from a policy standpoint that can fix the disruptions.
Okay, I appreciate both your perspectives. Thank you. Thank you, Mr. Chairman.
Okay, thank you. And on to, looks like next I have Lisa Middleton.
Thank you, Mr. Chair. Steve, this may be a bit of a question that's better asked in closed session since it goes to some strategy, but looking at the real estate investments that we have, is this perhaps a time that home building should be something that we get more heavily into, given where real estate home prices are going and the uncertainty in the office market?
Yeah, I think I would probably want your staff to take the lead in responding to that strategic question and deciding on whether that's more open or closed session. I will note one thing, Ms. Middleton, on residential real estate. There is seemingly significant pent-up demand for housing in the economy. But the constraining factor may not be capital. The constraining factor may be laws that prevent development and higher density development all across the country. And so it's a supply chain issue. We don't have the supply of houses because we don't have we have regulations that prevent as much housing coming into the market than the market would demand at this point in time.
That's a really interesting observation, one I think I want to follow up later. One of the good news stories that I heard from you was our success in opportunistic strategies. And could you elaborate a bit more on why we have been successful in opportunistic and what lessons we can take from that?
Yeah, I think I'll have Tom answer that because that was under his report and purview.
Ms. Middleton will be happy to. And in fact, I think it dovetails well with the discussion that we had around the asset allocation process and the new targets. A significant portion of the underlying strategies within opportunistic strategies are private debt investments. And given structuring and the, I'll say, increased spreads there relative to public opportunities, that's one of the key drivers of the strong performance. There is judicious deployment of capital with high quality partners, and then the market repricing, some spread tightening associated with those investments.
Right. Thank you.
Okay, I'm not seeing any more hands up or requests to speak in the chat. So I will thank Steve and Tom again for the presentations and the answers to our questions. And I will turn it back to Mr. Dan Benvenu and Arnie Phillips and Lauren Rossborough Watt for our CalPERS trust level review, which is item 7B.
All right, thank you, Mr. Miller. And Tom, Steve, thank you for the update. And yes, that takes us to item 7B, which is the companion item prepared by the CalPERS investment staff. So can I ask we please bring Lauren Rossborough Watt forward to join Arnie and me here in the presenters area. And let's keep Tom and Steve here also in case questions come up that dovetail there as well. And if we could please get the slide deck up. Okay, so as mentioned, this item is one of the two semi-annual trust level reviews that we conduct each year. The goal of this item is really to provide the committee with information about the portfolios and their performance, key business initiatives designed to support and enhance our investment program, and then some of the market and economic conditions within which we manage the portfolio. We've got three main parts for this item. I will start by giving an overview of the performance of the Public Employees Retirement Fund, or the PERF, and then also the affiliate trusts. From there, Arnie will provide an update on some of the risk positioning in the portfolios, along with the investment office operating model. And then we'll finish with Lauren Rossborough Watt providing an update on global market and economic conditions. So with that, let's get started looking at our performance. Next slide, please. Okay, so before we get into the details, I just want to draw your attention to a few key numbers surrounding our performance. As we've discussed before, the longer horizon numbers are really the important ones, and Mr. McCourt, certainly alluded to this, as they are subject to really kind of less, maybe misleading swings that you can have, as they speak to a return generation over a period of time that more closely aligns with our liabilities, and it smooths out some of those swings. And of course, when I say our liabilities, we know those are multi-generational liabilities. So first, let's look at absolute return, which is primarily the result of strategic asset allocation that we select together through the ALM process. An absolute return, of course, is a critical number because it's the absolute return that pays the benefits to our 2 million beneficiaries. And over the 10-year period, the PERF returned nearly 10%, coming in at 9.7%. Now, the second number I'll call your attention to is the excess return, which is a combination of the implementation of the strategic asset allocation along with active decisions taken by the investment team. So this too is a critical number as it measures really how staff is implementing the portfolio, and this is the number that staff has kind of greater direct influence over. And over the 5-year period, the excess return as of the end of December was a positive 10 basis points, or 0.1%. And then finally, worth noting is that the affiliate trusts continue to perform in line with expectations based on their respective asset allocations. And it is worth just kind of providing a quick reminder that there are nearly $30 billion in assets here. So performing in line with expectations is a really good thing and reflects the work of a really talented team of individuals managing these allocations daily. So now that we've gone over a couple of highlights, let's keep going and look into some of the details. Can we get the next slide, please? So as we look at this table, we can see that the PERF and many of our affiliate program trusts reflected in their performance here. So starting with the PERF, returns exceeded 7% across all periods 1 year and longer, and really reflects the positive performance in all time periods except for 20 years, which still includes the effect of the Great Financial Crisis. And by positive, I mean positive relative return, certainly positive absolute returns across the board. And when looking at the affiliate funds, we're reminded of our investment beliefs, really, where investment belief 6 states that strategic asset allocation is the dominant determinant of portfolio risk and return, with the performance of these trusts really following the asset allocation of each one. For example, in the most recent, say, decade, we can see that the funds with the higher weighting to equities, similar to the PERF, have the highest returns given the strength in the equity markets over this past decade. So now let's turn to the next page and look at the PERF in more detail. And there are a handful of things I'd like to highlight. Okay, so first, starting at the bottom left of the table, you can see that this end of the calendar year time period is the first time period where we closed with more than $500 billion in assets, more than $500 billion. And this has to do with both contributions, but then also importantly with buoyant markets. And then second, I want to take a moment to highlight really some of the great work and great momentum we're seeing in our private asset classes. And I know Steve McCord in his update talked about this, but I'll cover it briefly also. So looking at private equity, the private equity allocation has gone from less than 7% of the total portfolio just over a year ago to nearly 10% of the allocation. Now, part of that is due to strong performance. With the asset class being up 40% in this past calendar year, that certainly increases the allocation. But part of that is also due to really good momentum in underwriting, committing, and then deploying capital. A key mantra for the private markets teams across the board have been all about committing at scale with high underwriting standards and then cost advantaged economics. And that's what we're seeing get executed on. That's a strategy we've talked about, and that's really, really quite gratifying. Moving on to real assets, its allocation also has increased significantly from less than 10% just at the beginning of the year to over 11% by the end of the year. And this too is the result of strong performance of 16%, but also to some really great work by the team and really broadening the ways that we commit and deploy capital. And again, that deployment at scale with high underwriting standard and cost advantage economics, that's really critical to our strategy. And then the final area of deployment I'll call attention to is opportunistic strategies, which I know we had a question on in the previous item. This is where we're building the private debt exposure that we know was added to as an asset class with a 5% allocation in this most recent ALM cycle. The exposure here increased more than fivefold over the year from less than $1 billion this time last year to nearly $5 billion at the end of December. And this impressive level of deployment across all of our private asset classes really is clearly aligned with our strategy and our new strategic asset allocation. And it really represents some of the great work being done by, Greg, Sarah, and Jean, but really importantly also their entire teams in private equity, real assets, and then private debt, respectively. So I just really want to take a moment to acknowledge the really great work by the team. And in addition to the deployment of asset classes being very encouraging, another data point I'd like to call your attention to is the performance, both absolute and relative. We obviously look closely at absolute returns because, as mentioned, it's the absolute returns that pay the benefits. And you can see that over all time periods, a year and longer, as mentioned, the absolute return exceeds the target rate of return. So that's very good, knowing, of course, that that'll pay the benefits to our 2 million members and beneficiaries. But in addition, though, and this is the part where the team has greater influence over, you can see that on a relative or excess return basis, we've outperformed with lots of green numbers in the excess return columns. Now, with all time periods except the 20-year, which as mentioned, it still includes the effect of the great financial crisis, the PERF is outperforming the total fund benchmark, exceeding by 120 basis points at the 1 year, 40 basis points at the 3 year, 10 basis points at the 5 year, and then a basis point at the 10 year. And again, I'll remind us to maintain a long-term perspective and really focus on the longer-term numbers. Recall that that 1 year number was a negative 40 basis points just 6 months ago at the end of June, and is now a positive 120 basis points at the end of December. So those are those kind of potentially misleading swings that we were talking about. For this reason, it's the 3, 5, and 10-year numbers that tend to mute these swings that we really like to focus on. And really, we've seen a great turnaround in the performance at those time periods. And that's really gratifying, I think, work and really great success of the team and something to really, applaud the team for. Now, down at the asset class level, it's a really similar story with returns exceeding benchmarks in most asset classes and most time periods. And I have to point out that in the case of the fixed income asset class, this report reflects outperformance at every time period, which really is great work by that part of the team. Now, we know that we're a long horizon investor, and we have to stay focused on and continuing to generate absolute returns, both absolute and relative returns, to pay benefits to our 2 million beneficiaries. We can't and we won't get complacent. But again, these are really encouraging data points, reflecting some really great work by the entire team, every asset class, all the support functions. We know that it comes together, and results like this come from a real team effort. So I did want to call your attention to it. Next slide, please. Okay, so as we've shared before, the PERF has a large allocation to growth-oriented assets, to equity-type assets, and therefore it exhibits similar return patterns, really largely following equities, but with a smaller magnitude of moves, given the diversification properties that we've put into the strategic asset allocation over the past 5 years or so, and we've done that together. When equities are up, the PERF will be up, but historically by about half as much. And when equities are down, the perf will be down, but again, historically by about half as much. And as I say, this is due to the strategic asset allocation and the diversification we've put into that strategic asset allocation over the years. And the addition of leverage to the strategic asset allocation at the November investment committee meeting, which will be implemented over the next cycle, that really furthers that work toward a more diversified and more defensive portfolio. So that covers my update on performance of the various trusts. At this point, I'm happy to take any questions if we have them on performance, or I can turn it over to Arnie to cover portfolio risks as well as our business model update.
Okay, I'm not seeing any hands up, so we will continue on then.
Sounds great. Arnie, over to you.
Thank you, Dan, and good morning, members of the committee. This slide here is the first one on the risk section. And as Dan mentioned, our performance is highly dependent on returns from equities and other growth-oriented markets. A similar concept applies to our risk profile. The PERS risk is dominated by assets sensitive to economic growth, primarily equity risk, but we also have exposures in our credit portfolios and our real assets portfolios also. The middle part of the slide shows our actionable tracking error. As you recall, for members that have been on the board for a while, at the September meeting last year, the board approved an active risk metric of actionable tracking error. This measures the deliberate and controllable departures from the policy benchmark. It includes the impacts from public market strategies and asset allocation. Total fund policy actionable tracking error limit is 100 basis points. As this slide shows, our current actionable tracking error is only 19 basis points. So a relatively modest level of active risk. And it's actually down a little bit from last year's report when we were at 26 basis points of actionable tracking error. Finally, it's worth mentioning on this slide that the portfolio remains highly liquid, both in terms of having a great deal of liquidity on the balance sheet, but also having multiple pathways to create additional liquidity if needed. As we've discussed many times in prior IC meetings, centralized management of allocation, leverage, and liquidity has been a key area of focus for the investment team in prior years and will continue going forward. As we add private assets and considering the illiquid nature of those investments, maintaining our focus on liquidity and doing so in a centralized total fund way remains critical. Next slide, please. So this slide illustrates the decomposition of risk and the relative size of the risks in the portfolio, starting with total fund tracking error, and then showing the portion of total fund tracking error represented by actionable tracking error. We had committed when we made the move to actionable tracking error that we would still be showing and presenting total tracking fund error. And so we are showing that here. The pie chart on the left gives us the total volatility, which is 10.6% currently, down from 11.5% last year when we went through this presentation. Two key components of that. Volatility comes from the strategic asset allocation or the benchmark. And then the portfolio and how it differs from the benchmark, the composition of that equals total tracking error. Moving to the middle pie chart, we can see total tracking error of 139 basis points. Now this is actually up from 110 basis points last year. And total tracking error has been increasing due to the higher allocations to private assets that Dan elaborated on, especially private equity. Dan mentioned private equity went from 7% to nearly 10% last year, and real assets increased 1% from 10% to 11%. So that impact on total tracking error is completely expected. As an example, private equity is benchmarked against a public equity benchmark. If we wanted a zero tracking error from private equity, we would have to actually invest in public equity because tracking error shows how the portfolio differs from the benchmark. And since public equity is the benchmark, allocations to private equity increase tracking error. We invest in private equity to earn the expected return premium over and above what private equity or public equity returns. So as our allocations to private equity have increased for good reasons and at a very good pace, we will see an increase in tracking error totally expected. And then moving to the right side of the chart here, we can see 19 basis points is what we would call actionable tracking error, meaning the result of decisions that the investment team has intentionally made and that staff could change if desired. Decisions that are controlled by staff have contributed only a small amount to our total tracking error. Actionable tracking error, as I mentioned, is actually down from last year when it was at 26 basis points. Next slide, please. This slide gives the committee a snapshot of the investment office's operating model and our aggregate risk score, which is actually unchanged from last year. Our risk level of 4 reflects a very mature operational control framework. The majority of the functions and activities are on average low to medium risk, which is a reflection of the team's focus on proven processes and dedication to continuous improvement. 2 key areas that we continue to work on, and it's hard to imagine we won't continue to work on them for quite foreseeable future, revolve around our operational infrastructure, specifically in the areas of technology management and information security and data management functions. With that, the return and risk portion of this deck is done. So I'll stop and see if there's any questions on either of those before we turn it over to Lauren to give a quick economic update.
Okay, thank you, Arnie. I'm looking and I'm not seeing any questions come up at this point. So we'll move on to Ms. Rosborough-Watt.
Thank you, Mr. Chair. Good morning, everyone. Thank you again for having me here today. So the plan today is to give you a brief summary of what we spoke around last time, and then to shift to what we, meaning CalPERS, see happening in the global economy and what we see looking forwards. So many of the themes that I'm going to touch on today were spoken to by Mr. Thomas Toth and Mr. Steve McCourt. I want to share with you more the framework by which we think through these issues and how they impact the economy. So briefly, just looking back last year, I spoke about the global rebound from the pandemic-induced recession. And this rebound, I said, would continue into late last year, which we've seen. Also spoke in 2020 around changes to the FOMC's mandates, specifically how they had moved to a flexible average inflation targeting regime, and that the Fed would also assess the degree of labor market slack when making policy decisions. So compared to the old framework, we interpreted that meant the Fed would tolerate a stronger labor market and higher levels of inflation before tightening policy. And then late last year, I spoke about the delicate balancing act of policy stimulus waning and how this would play into GDP growth normalizing and the risk that this could result in some volatility in outcomes in asset markets as a result. So that's sort of where we've come from. So where do we see the economy now and what's changed? So economic growth is reverting towards historical averages. So Q1 2022 is likely to be somewhat softer than what we've seen in recent quarters due to a timing effect. But over the 2022 calendar year, real economic activity is expected to grow around trend. And I'm sure you've experienced talking about these supply side constraints. I certainly have. You know, this is one of the remnants of the pandemic, and it looks to have quite a long tail on it. So in particular, durable and intermediate goods. But what I do want to talk about is the supply of labor. And just briefly, services spending, which plunged dramatically in 2020, has certainly improved. Although, just to point out, it still remains 4% below its pre-pandemic trend. So we have this restriction in supply, and that's what economists call a supply shock. And the result of that typically is to increase prices and to push down on real economic activity. Now, to Ms. Middleton's point, the labour share of output has increased from its 2010 lows, but it still remains low compared to history. And more recently, the latest figures on private sector average hourly earnings are up 5.7% on the year. But core personal consumption expenditure prices, so one of the core indicators that the Fed looks at, is up 4.9% in the same time. Households have also taken on $1 trillion worth of more debt. So typically we have a robust economy and rising wages. Typically that encourages labor back into the workforce. The employment rate's at 4%. The wider U6 measure that includes marginally attached workers is also near historical lows. But there are still 1.3 million workers less employed than we had before the pandemic. And there's some estimates suggesting there's been an excess retirement of around 2.4 million people. Over the past 6 months, so the period when government support has been waning, we've had personal income growth at an annualized pace on par with the pre-pandemic trend. So we've got a supply of labor that is not yet normalized, and yet we've got demand that remains robust. So more demand and less supply equals what we call an excess demand situation. And the result of this is pressure on wages and prices, with activity to continuing to grow. So you can see the two frameworks I'm talking here. To the next slide, please. So the economy is no longer so weak, and yet, to Mr. Toth's point out, real interest rates remain historically low. And as such, it's reasonable that the Federal Reserve has determined that the degree of policy support is no longer warranted. Although I would want to widen that to global central banks in aggregate, as other developed market central banks are either tightening policy or indicating that they plan to do so, and many emerging market central banks have been tightening policy for some time. Now, I did want to highlight the chart here on the right-hand side. It is somewhat stale. The grey bars should be perhaps 0.25% to 0.5% higher. So the market has certainly priced in a greater degree of tightening over 2020 than what they did when this chart was prepared. So that's sort of where we're looking. And when we think about what our role is here, we look at the distribution of future macroeconomic outcomes. And what we're trying to do is to understand the drivers and the assumptions that are driving these outcomes. Given all the information, what is more or less likely to transpire, and what might change in one of these assumptions that will then change the likelihood of the outcomes. So it's this process of constantly critiquing and questioning. So to that end, when we look ahead, we see both upside and downside risks to both growth and to inflation. So the US economy looks resilient to the Fed, both raising interest rates and reducing the size of the balance sheet. The communication that the Fed undertakes could help this process or hinder financial market pricing volatility. And we get the Fed minutes due tomorrow that will help to provide us some insight into their expectations for this year. There are some factors that give us pause as to the degree of policy tightening in the near term. So while employment is robust, but still not pre-pandemic levels, the distribution of employment outcomes still remains wide. Inflation is eroding the real purchasing power of the consumer. Until recently, asset prices have performed relatively well. And we have geopolitical events that are weighing on market sentiment, confidence, and uncertainty going forward. Happy to take any questions. Back to you, Dan.
Okay, thank you for that presentation. And I'm looking, I don't see any hands up or questions in the chat, but it's very, it's, there's encouraging and there's, things to come. So we'll see what the future brings, and I appreciate your presenting this outlook, and we'll, yep, no questions, and so we'll wrap up this section. Any last words, Dan?
No, thank you, Mr. Chair, and Lauren, thank you for joining Arnie and me on that, and that does conclude our prepared remarks. So absent any last questions, we can move on to the next item if that's the desire of the committee.
Great, thank you. I think we will, and just with great appreciation for the hard work through all these ups and downs from you and the entire team. It's keeping that focus on our strategic direction as long-term investors. It's nice when we're having the ups and seeing these fabulous results, but we also know that constancy of purpose through the downs and the next set of ups is really what's going to keep us sustainable in the long run, and really appreciate all the hard work and dedication. So let's move on to the next item then, and want to introduce Samizo Zima.
Yeah, thank you, Mr. Chair, and thank you for those comments. Agreed that, with whether it's the pandemic, the pivot to remote, and now migrating back to the office, I think the team has done really great work. And to your point, results are showing it now, but we can't and won't get complacent. We do know that it's a long horizon game. So and I appreciate the comment on sustainability, which is well timed, being as we're moving on to our update on proxy voting and corporate governance. And I see that Samiso has been brought forward. As mentioned with us being long-term investors, very long multi-generational time horizon type investors, we have to stay focused on the sustainability and the long-term performance of the fund. We know that corporate governance activities really are an integral part of managing the global equity portfolio and really the entire portfolio in that sustainable way, to generate returns, to pay benefits to those 2 million members and beneficiaries. So this next update is a really critical one. And with that, I will turn it over to Samiso to walk us through our corporate governance and proxy voting and engagement update. Samiso, over to you.
Thank you, Dan, and good morning, members of the Investment Committee. And congratulations to Mr. Miller and Mr. Fechner on your leadership role in the Investment Committee. So the agenda item in front of you is meant to do two things. The first thing is to provide you with a preview of the priority areas for the 2022 proxy season. And then the second thing really is to provide a summary of the 2021 proxy season outcomes. Let's move to the next slide, please. So here there are four main priority areas that I'll talk through. And for the members who've been on the investment committee for a while now, this will seem really familiar because we've been consistent in terms of working through these areas. And I'll start with the executive compensation. Really here we're looking at ensuring that the pay that we give to executives at companies is aligned with the performance that they deliver. I think throughout this presentation, what you hear is that the work that we're doing in corporate governance, that the team is doing, is really about investment returns. And as you all know, that 60 cents out of every dollar that we pay out in benefits comes from investment returns. So this is really an important area, and ensuring that executives only get paid when they deliver performance is something which is really important for us. On corporate board diversity, again, another area where a growing body of evidence shows that diverse teams perform better than non-diverse teams, and they lead to better performance returns and higher innovation. So really it's important that we look at this again from an investment perspective. There may be some ancillary benefits from a social perspective, but we're coming at it from an investment perspective. And then on climate change, really here we're engaging companies in terms of getting them to incorporate the risk and opportunities that arise from climate change as they sit out their long-term strategy and as well as capital allocation. And then the last priority item here is in investor rights. This gives us the ability really to hold boards accountable in any of these areas. So when we talk about proxy access, which is the ability for investors to put or to nominate directors on company boards, and then majority voting, which is where we vote for directors and ensure that directors should get a majority of votes cast as opposed to on a plurality basis. And the four priority areas, these are not the only things that we actually cover. We cover other things, but I just wanted to, to focus on this because these are really the priority areas for the 2022 proxy season. If we can move to the next slide, please. So on this slide, we're summarizing the outcomes from the 2021 proxy season. Again, we have those four priority areas listed here. So on executive compensation, we voted against 55% of pay plans in the US. This is the highest number of against votes that we've ever recorded. We don't stop there with just voting against, the pay plans themselves. We also vote against members of the compensation committee to hold them accountable for some of these poorly designed pay plans. So we voted against over 3,000 compensation committee members in 2021. On corporate board diversity, the companies that we've engaged since July 2017, 75% of those companies have since added a diverse director to their board. And if we eliminate companies that have been delisted or acquired, 83% of the companies that we've engaged have added diverse directors to their board. And again, as in with the executive compensation, we also vote against directors where we don't get any progress in terms of the engagements on corporate board diversity. And on climate risk, CalPERS is a member of the Climate Action 100 steering committee, as well as the chair of the Asia Advisory Group. And the Climate Action 100 has over 600 signatories, as well, with over 65 trillion in assets under management by now. And CalPERS leads on the engagement of 22 companies of the 167 companies. And 17 of those companies have now set a net zero target or ambition, net zero by 2015. And then on enhanced investor rights, really this is again trying to make sure that we have those tools in our toolbox to be able to hold boards accountable where they are not aligning the direction of the company with investor interest. I won't get into the appendix. The appendix has a lot of details covering each of these 4 areas, but I'll stop here and take any questions.
Okay, thank you for that very encouraging report. And I have a question from Teresa Taylor.
I know I'm always the person asking questions. I do want to thank, I didn't say anything earlier, Dan and Arnie and everyone for their report. It was a very good report. I'm very pleased with the work of the investment office, and you guys are doing a fantastic job. So I just wanted to get that out. But for the report here, Sumiso, and again, thank you, although as I understand it, this isn't your job anymore. So congratulations on your new position, but thank you for reporting to us on this. I had a question. I think it can be for each of the, whether it's corporate engagements for executive comp or board diversity or climate risk, as we, I guess mainly climate risk, as we get these commitments, right? Like the 17 of the 22 companies that have committed to net zero, what do we do? Do we proxy vote when we're seeing that they're not actually demonstrating that commitment? For example, I don't remember who it was, but one large fossil fuel company continues to get licenses to drill, whether that's for shale or whatever, and they're not really demonstrating they are coming up with a business plan that moves them to the net zero. So what do we do with that? Does that come out in proxy voting?
Thank you, Ms. Taylor, for that question. Yes, indeed. So making a commitment is just the basic, it's just the starting point. And what we are doing is that we continue to engage with those companies and look for milestones in terms of what are they actually doing on the ground in terms of trying to get net zero by 2050. We all know that, 2050 is still a couple of decades away, and a lot of those maybe CEOs who may be making those commitments now may not be in those positions by then. So we look for intermediate milestones, and as you may know, the Climate Action 100 Plus came out in March 2020 with a net zero benchmark. And the first time we used that benchmark was in March 2021 when we benchmarked all the companies. in there. And the second iteration of that benchmark is going to come out in March this year. So we're actually using that benchmark to measure progress in terms of what companies are doing. And as we measure that progress, that translates into our proxy voting. So we, if we see a company that's not making progress, we vote against, members of the board, either members who are responsible for climate action or the board in general. And what we've also done over the years, and will continue to do, is that even where other investors file shareholder proposals that are aligned with the objectives of the Climate Action 100, we'll actually run proxy solicitations, to get other investors to support those proposals. So we did that last year. We've done that over the number of years, but everything I think goes back to proxy voting, and that's something that we'll continue to do. I think we have, for this proxy season, we have explicitly come out and updated our proxy voting guidelines to state that we'll be, voting against directors where companies are not making progress on climate change.
Okay, thank you. And I see that that is also the case with corporate diversity and accountability. You actually stated that in here, so I do appreciate that. And thank you again for the report and the hard work.
Thank you. It's all the team. I'm just doing the presentation.
Yeah, and we certainly appreciate all the work of the team. Just the sheer volume of work that's been done in this area is pretty amazing. So next I have Controller Yi.
Thank you, Mr. Chairman. Thank you, Sumiso, to you and your team for all this outstanding work. Just to follow up on Ms. Taylor's question, I was curious, this on slide 9, I guess it just struck me that we're kind of mentioning net zero targets and ambitions in the same line, and I'm just trying to figure out kind of the role of Climate Action 100 Plus in ensuring that a company's ambition actually becomes a target. And so, can you speak to that? And I guess maybe that's really the nature of the engagement that you're having.
Yeah, thank you for the question, Controller Yi. The engagement is meant to move the company from that ambition to target. And the net zero benchmark, which really has, the short term, the medium term, and the long term targets, is helping us in terms of that. So we're able to, engage with the company, but also measure the company's progress based on what's in the benchmark. And the companies have an opportunity once the benchmark has been populated, which is populated by a third party. Each company is sent, what has been populated, and they can correct anything if they think that there's something wrong. But it has to be something which is verifiable. So really, this is an ongoing activity, and what we're looking at is working with the companies. And the companies which are really progressive in trying to do the right thing and incorporate the ability to survive under a low carbon economy. And then there are laggards, and with those laggards, we'll be seeing more against votes, not just from us. I think other investors, are really taking this issue seriously, as they should, since it affects, the returns of these companies over the long term.
Right. Right.
Yeah.
Okay, good. I appreciate that. And then really applaud you and the team for just the progress we're seeing with respect to corporate board diversity, and certainly CalPERS has been on the forefront of that for a very, very long time. In terms of engaging companies on human capital management issues, can you speak to other issues that are the subject of engagement besides the say on pay proposals?
Yeah, so on human capital management, and we work on this issue with board governance and sustainability. I think James Andres is the interim managing director in that group. But we work together in some of the issues that we look at around company culture, sexual harassment, misconduct, worker safety, and so forth. Really, at the end of the day, most of our work is based on understanding the evidence, which shows really that a happy employee is a more productive employee. We all know that when we are happy, that's when we do our best. And so we approach all these areas and all these issues are based on that. And so there's a lot of work that is going on there, both from actual engagement with companies, but also in terms of interaction with the legislators and regulatory bodies in terms of having better disclosures on issues around human capital management.
Mhm. Okay, I appreciate that. And thank you. And I'll just say thank you, Ms. Frost. I know we've been involved in some conversations about this. And I was curious or actually interested in maybe having a more deeper dive on just some of the things that we're looking at, particularly with companies that are doing well with respect to investment returns for us right now, but in the long term, and just given what's happening in the economy with the future of work and just kind of worker issues generally. I just questioned the sustainability of performance with just some of the practices of companies. And so just did send over a letter and I look forward to that discussion coming back to the board after the staff takes a look at it.
Got it. We'll have Dan take that down as committee direction if it's okay with the chair.
Sounds good.
Great, thank you.
Okay, I'm not seeing any more questions or hands up. Oh, is that Ms. Middleton? Lisa? Okay.
This is going to be really quick, and it's basically me too. But I think the point that Controller Yi was making with regard to human capital management is something that we really do need to emphasize, and I want to add my voice to that. Thank you.
Great. Thank you, Lisa Middleton. And not seeing any more hands or questions. I believe we do have a public commenter on this item 7C. Mr. Fox.
Yes, Mr. Chair, we have one caller on item 7C, Mr. Jim McRitchie.
Okay, go ahead, Mr. McRitchie, you have the floor.
Okay, heard the buzz. Well, thank you very much. I'd like to say that overall it looks like great work with engagements really paying off. I do have a few questions. When voting on equity compensation plans, is any consideration given to ensure that incentives are broad-based, like going to all or most employees rather than just named executives or directors? And if so, does CalPERS have any way of tracking how those incentive shares were actually awarded below the CEO and board level? You have milestones. For example, in my own proposals, I'm asking for disclosure by EEO1 categories of those broad-based incentives. There's plenty of evidence that shows that shifting some incentive awards from the top towards the bottom would help address wealth inequality while raising productivity and overall GDP. Second concern is it's great to see the votes against CEO pay not aligned with performance and comp committee members as well. That's very important to include votes against comp committee members. Is CalPERS doing anything to avoid the automatic ratcheting of executive compensation due to annual surveys and boards assuming their CEO is above average, usually like 75th percentile? So every year that average goes up because of that ratcheting surveys. And another concern is board diversity. So at unresponsive companies, it looks like the hammer's been vote no campaigns. And I'm just curious, are those aimed solely at the nominating committee, or are others sometimes involved? And if others are involved, then how are they selected? And then the last thing I'd like to bring up is on proxy access. I noticed that CalPERS is filing proposals with a group limit of 20 in their proxy access proposal. And as you may know, proxy access has only been used once. So, and I think it's probably due to that 20-member group limit on those wishing to file under proxy access provisions, typically limiting to 20 members, you can't get 3% held for 3 years. So I would advise either lifting that cap altogether or at least lifting it to 50 or higher. And I've been somewhat successful in those efforts, but of course, if CalPERS is doing it, it'd be much more success in that area. Thank you.
Okay, thank you, Mr. McRitchie. I think that concludes all our public commenters, Mr. Fox.
Yes, Mr. Chair, for now, the next public comment is on 7E.
Okay, so I don't know if you had anything you wanted to add, Samiso or Dan?
No, I think that covers our item. Mr. Chair, if you direct, we're happy to reach out to Mr. McRitchie and answer some of his questions and
Great.
kind of engage
I
directly
think
with
that
him.
would be helpful.
Okay, we'll take that as committee direction then also.
Okay. And so, yeah, so anything else, I guess, summary of committee direction.
Sounds great. And really quickly, before I get to that, I do just want to thank, first of all, Ms. Taylor for her kind comments, but then also really thank, I was probably remiss in not mentioning the support of the board is critical to us being able to execute and stay focused. So I definitely want to just express a sincere appreciation to you all for all the support that you give us and, in doing what we're here to do. Let's see, I've got two committee directions that I took. First of all, we will reach out to Mr. McRitchie, but then second of all, to Controller Yee's request, we will plan on bringing back more information, possibly with the educational item in July. But we'll bring back an item on HCM and how all of that feeds into sort of corporate management and how we're thinking about all of those to drive investment returns. And those are the two bits of committee direction that I have.
Okay, sounds about right. So at this point, I think we have another public commenter for the item 7E public comment. Mr. Fox.
Yes, Mr. Chair, we have 4 callers. The first is Eddie Usidi.
Okay, commenter, you have the floor.
Mr. Chair, apparently he stepped away. I'll return to you and I'll go to the next one. Next, we have Harry Gibbs.
Okay, Mr. Gibbs, you have the floor.
Hello. Hi, this is Carrie. Good morning.
Good morning.
Can you hear me?
Yes, you have
Hi.
the floor.
Hi, good morning. Can you hear me okay?
Yes, can hear you fine. Go ahead with your comments.
Okay, great. Okay, hello, good morning. My name is Carrie Gibbs. I'm a resident of Santa Rosa, California. You are committed to responsible investing, and I'm here to discuss a growth failure which victimizes myself and many other Californians and people around the country. Apollo Management, a significant external manager, is controlling investor in the Hertz car rental company, holding much of its stock and appointing a senior portfolio manager to Hertz board. Other external managers may have significant investments in Hertz. Hertz has a national practice falsely reporting to police that a car it can't find or whose rental it believes to have expired was stolen by the last customer to rent the car. Its internal records are a mess, and their filings are incomplete and unverified theft reports for the purpose of using the police as a taxpayer funding repost service. Apollo and other controlling investors know these false police reports caused the arrest, often at gunpoint, of customers who's returned their vehicles, renewed the rentals, or at most disagreed about when or where the car has to be returned. These are the worst civil payment disputes. Victims and their families often suffer the physical, emotional, and economic traumas of days, weeks, or even months in jail. much of the falls on people of color. Many false reports are made in California or against Californians. I had an insurance rental from Hertz Grass Valley and Truckee locations in 2019. I exchanged the vehicle several times and was in contact with the company during the rental. Despite this, I was arrested, jailed, and then prosecuted in Grass Valley for a year until the case was dismissed in 2020. I thought it was over, but the passport applications kept getting denied. I finally was told in late 2021 that Hertz had another warrant against me in Reno, Nevada, the same rental, even though I never rented a car there. I have an active warrant pending for my arrest in the state I never even rented a car from, even though I beat the Hertz theft case. I and hundreds of other victims have filed claims against Hertz in its bankruptcy. Apollo and other controlling investors have let Hertz do nothing but defame victims and impose procedural obstacles to fair treatment of claims. Just as bad, Apollo and other controlling investors are making new victims by permitting Hertz to continue making false police reports. If this doesn't change, Hertz security should be restricted from all your portfolios, and Apollo and other managers who directly permit continued misconduct influence should be redeemed and barred from future RFPs. The moral imperative is more than enough, but retirees must also be protected from impacts from the inevitable commercial and regulatory consequences we'll have upon Hertz securities. Thank you.
Thank you for your comments. Mr. Fox, next caller.
Thank you.
Yes, Mr. Chair, the next caller, Sarah Thies from Fossil Free, California.
Okay, Sarah Thies, you have the
Hi,
floor.
you all know me, Sarah Thies, Fossil Free California, and grateful CalPERS retiree. Today I'm commenting on the fiduciary duty training in January, specifically about diversification, whether divestment is merely political, and your reliance on experts. Ms. Richardson stated that if you divest, you are less diversified. However, I think a literal interpretation of the word is a mistake, and the California Constitution doesn't require this. As Ms. Taylor pointed out, exclusion can be strategic. And as I'm sure your Siri researchers know, there is literature supporting the fact that you can exclude one sector from a portfolio and do fine. Various institutions around the world have committed to fossil fuel divestment. This includes the Dutch pension fund ABP with 650 billion AUM, New York State, Ireland's pension fund, London, and New York City. Caisse de dépôt et placement de Quebec has 308 billion in assets and is selling off its oil companies. The Norwegian Sovereign Wealth Fund, which has 1 trillion in assets, is unloading 13 billion worth of its fossil fuels. So the question is, have the trustees of all these pension funds abandoned their fiduciary duty? The answer is no. As BlackRock and Makita separately concluded last year, investment funds have experienced no negative impacts from divesting from fossil fuels and in fact have found some evidence of modest improvement in fund returns. The next point, the view of Ms. Richardson and at least some on the board is that divestment is political. It's true that in the US, divestment and anti-divestment activities are tied to blue and red states, but it's worth asking first whether one can dismiss the divestments just described as solely political. Second, what underlies this characterization? How much of this is due to the now well-known decades-long campaign of climate denying and lies by the fossil fuel industry and the massive amounts of money this industry spends on lobbying and contributions to political campaigns of our representatives? Just about all of it, I would say. And finally, reliance on experts. Ms. Middleton alluded to the fact that all of CalPERS experts are in favor of CalPERS approach, that is, engagement over exclusion. But as Controller Yee commented, it's hard to have a conversation when those advocating for divestment are not present. I urge the board to fully exercise its duty of care and bring consultants into this conversation who understand how divestment can help improve a portfolio. Thanks so much for your attention and listening.
Thank you for your comments. Mr. Fox, our next caller.
Yes, Mr. Chair, the next caller, Sandy Emerson from Fossil Free, California.
Sandy Emerson, you have the floor.
Thank you. I moved to Charleston, South Carolina, as I was finishing high school. That historic city still had a shopping area called the Old Slave Mart. With its souvenir shops and crafts boutiques, this plaza had been completely transformed from its grim as part of an economy of trafficking in enslaved Africans. The economic system of slavery was overturned, although its sordid legacy continues. The Old Slave Mart is an example of an economic system that was overturned for moral reasons. People don't overtly invest in slavery anymore, just as CalPERS now restricts investments in Sudan in tobacco, assault weapons, and a small number of thermal coal companies. As you know, CalPERS equity investments are controlled by a benchmark driven by the market as a whole, and CalPERS Custom Index uses the whole market to determine its fossil fuel equity investments. In fact, all equity investments. CalPERS portfolio managers make many investment decisions, but not about equities. About half of CalPERS' total assets are managed passively according to the whims of the global market. Like all investors, CalPERS returns have been lifted by the hyperactive market of the last few years, and fossil fuels have recently experienced the expected post-pandemic surge. But should investment decisions on something as important as our future be left to the market as a whole? CalPERS knows from its engagement experiences that the fossil fuel industry is highly resistant to change and continues to spin elaborate schemes to reach net zero by means of using unproven technologies to produce lower carbon intensity products rather than moving to transform its business to lower total carbon emissions as required by the IPCC scientists. Big Oil's expansion plans guarantee that we won't reduce emissions at the scale and speed required to stop overheating the planet. Will CalPERS remain a slave to the market, or will it take control of its equity investing and restrict investing in fossil fuels? That's the burning question. Will you use your power as a board to stop enabling polluters? We have about 8 years to reduce emissions by 50% by any and every means necessary. Many large pension funds and other institutions have concluded that the right thing to do is to divest and stop financing fossil fuel investments. Thank you.
Thank you for your comments. Mr. Fox, do we have one more caller or more than that?
Mr. Chair, we have two callers. If we get the previous caller back.
Okay.
First, we have Jin Zhu.
Okay, Mr. Zhu, you have the floor.
Good morning, everyone. Thank you for your great presentation. I just simply have two quick questions. The first one is, where's your return year to date? And the second one is, what's your outlook for the remainder of the fiscal year, especially for the currently downward stock marketing and the most likely Federal will increase the interest rate in March? Thank you.
Okay, thank you for your comments. Those were covered in presentations, but anybody want to jump in and recap that?
You know, we certainly can, Mr. Miller, although my guess is that there's maybe that's more of a question of the current year given the recent volatility. So why don't we treat that one the way that we did with Mr. McRitchie, and we'll just ask someone to reach out and engage with the caller.
Great, thank you. That would be appreciated. And Mr. Fox, our final caller, are they back available?
We'll check, Mr. Chair. We'll put them on now. This is Teddy Lucidi.
Yes, please.
Yes, please. Hi, good morning, everyone. My name is Dr. Chedi Usude. I'm a dentist and resident of Santa Clarita, California. I'm calling in regarding the Heads car rental company. And sometime in June of 2020 at the height of the pandemic, I took up a job at a rural hospital in Laytonville, California, and I did get a long-term rental from Heads on or around June 15th, 2020. I made the payments as and when due. Was in constant communication with the Heads rental company all throughout the duration of the rental. And then sometime in December of 2020, actually on December 16th of 2020, I had communicated with Heads rental that there was a COVID outbreak at the hospital where I worked, which is right on the California-Oregon border. And we agreed that I was going to return the car on Saturday, the 16th of December 2020. The rental was fully paid for. There was no money owed to Heads. There was no case of, there was no issue of the car being stolen because Heads knew pretty well that I'm a dentist and I've been paying for the car on a monthly basis. Anyway, to cut the long story short, I drove about 7 hours from Laytonville, which is like 300 miles outside of San Francisco, and then just got off the 5 North Freeway and drove into Santa Clarita. A few minutes later, I noticed a cop right behind me, a squad car, and then basically I was pulled over, and then I had about 8 squad cars, pull up around me, after me, and then basically went through the procedure of asking me to step out of the car right in the center of Bouquet Canyon Road. That's the road that I was pulled over on. And then I was asked to step out of the car with about 7, 8 squad cars with cops, guns all drawn, and then I was arrested, and I was told that Heads had reported the car stolen. I did explain to the cops that, well, the car is not stolen. I showed them documents of the rental agreement. I showed them history of the payment. And I told them actually my dental office was just a couple of blocks away from where I was arrested. And then I was basically told that there was nothing they could do anyway because Heads had declared the car stolen, and I would have to be arrested and taken over to the Santa Clarita police station. I was taken there, and I was detained overnight for about 24 hours, and then the following morning I was given a ticket which basically says I had embezzled funds from the Heads rental company. And I was asked to appear in court on a certain date. The following week,
time is running out.
Okay, yeah. So the following week, we went around the courthouses looking for a history or the file or the case that was filed in court, and we couldn't find any. And like I said, it's I think it's a problem where a company like Heads, reports people for cars, that are basically, in my case, not stolen. The car wasn't stolen; it was paid for. I was in constant communication with them. I didn't have any problems until I was just basically pulled out, guns drawn by over 8 squad cars. And believe me, it was about 7 p.m. at night. I could have been easily shot if I took the wrong step. If they asked me to, because they asked me to take 3 steps backwards and stuff like that, lie on the floor, I could have been easily shot and killed just for absolutely no reason.
Okay, thank you for your comments, sir. We appreciate it. Your time is up. Okay, any further?
Okay, thank you very much. Thank you.
Further public comments, Mr. Fox?
That concludes public comment, Mr. Chair.
Okay, well, that pretty much will recess into closed session for items 1 to 4 from the closed session agenda. The open session investment committee will reconvene following closed session. And let's take about how about a 10-minute break and reconvene in closed session at 11:40. Okay, see you all there. joining us. We'll be taking a break for lunch, and then the Board of Administration will convene at 1 p.m. So we'll see you all then.
Open session. And our first order of business is to call roll.
Teresa Taylor,
Here.
Rob Fechner,
Good afternoon.
Frank Ruffino for Fiona Ma,
Present.
Lisa Middleton,
Present.
David Miller,
Here.
Elena Ortega,
Here.
Jose Luis Pacheco,
Present.
Ramon Rubacava. Excuse
Oh,
me, Madam Chair.
excused. Yes, sorry.
Shonda Wesley,
I believe she's excused still.
okay. Betty Yee,
Lynn Paquin for Betty Yee.
okay. Lynn Pequin for Betty
Here.
Yee. Madam President, I have all in attendance with an excuse for Ramon Rubacava and Shonda Wesley.
Great, thank you, Ms. Hopper. Item number 2 on the agenda is the approval for the board timed agenda. Do I have a motion?
So moved.
So moved by Mr. Miller, seconded by Mr. Fechner. Ms. Hopper.
Rob Fechner,
Aye.
Frank Ruffino for Fiona Ma,
Aye.
Lisa Middleton,
Aye.
David Miller,
Aye.
Elena Ortega,
Aye.
Jose Luis Pacheco,
Aye.
Ramon Rubacava,
Excused,
Shonda Wesley,
also excused.
Betty, Lynn Paquin for Betty Yee.
Aye.
Madam President, I have a motion being made by David Miller, seconded by Rob Fechner on agenda item 2, the approval of the February 15th Board of Administration timed agenda.
Thank you. Motion carries. Item number 3, I've asked Mr. Fechner to lead us in the Pledge of Allegiance.
We all please hand over heart. Begin. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you.
Thank you, Mr. Fechner. Item number 4 is the board president's report. And I want to thank everybody for being patient with us. And let me begin by congratulating all of our newly elected chairs and vice chairs of our investment, finance administration, risk and audit, and performance compensation and talent management committees. And we certainly appreciate your service and commitment in these roles and look forward to working with you throughout the year. So February is Black History Month. It's an annual celebration of achievements by African Americans and a time for recognizing the central role of African Americans in our history. Our country has celebrated Black History Month since 1926. The originators, the Association for the Study of African American Life and History, sets a theme each year with a goal of further exploration, education, awareness, and action around issues of importance to Black Americans. This year's theme is Black Health and Wellness. It invites us to celebrate the accomplishments of Black individuals and to think about how Black communities have navigated physical, emotional, and mental well-being in the face of structural barriers that often result in disparate health concerns and outcomes. The theme is particularly relevant to CalPERS, as we will hear later this morning, the initiatives in our new 5-year strategic plan to ensure our own members receive equitable care. There's another reason why the celebration of Black History Month is appropriate today. We have a Black member of the CalPERS family who has made his own mark in the history of our organization, and I am speaking of none other than Henry Jones. Last month, our dear friend and colleague, Mr. Jones, announced he would be stepping down from the CalPERS board. There you are, Mr. Jones. As tradition has it, we would like to honor Mr. Jones today with a resolution from our board for his many years of service to CalPERS. Henry, I wish we were in the auditorium so we could physically present this to you. I would ask you to join me on the stage, but your smiling face, I can see right here. I'm excited to see you, and that will serve just as well. On behalf of the CalPERS board, I want to thank you for your 14 years of dedicated service to this board and all of our members and employers. Now, you've held a whole bunch of leadership positions during your time. You were the first Black president of our board and held that position for the last 3 years. You were vice president for 3 years and chair of our investment board and governance committees. You've been a strong voice on so many significant topics, including corporate governance changes and shareholder protections in the financial markets, diversity, equity, and inclusion in the investment industry, and the value of defined benefit plans. I know I speak for all of us on the board when I say thank you for your leadership and your friendship, and we will all miss you very much. Your resolution that I don't have in my hand, that I would love to hand to you, reads, the CalPERS Board of Administration individually and as a body express our sincere appreciation to Henry Jones for his many contributions and outstanding service to the system, and to extend our sincere best wishes to him. Henry, we wish you all the best in this next chapter of your life, especially good health and happiness. Thank you, Henry. It's good to hear from you. Go ahead.
Okay, well, thank you, Teresa, and all of my former board colleagues for the recognition today. It has been quite a journey over the past 14 years, and I'm beyond grateful for this experience. As you said, CalPERS is a world leader, and I'm proud to have been part of its history. and many firsts. During my time on the board, we hired the first female CEO, led the development of CalPERS investment beliefs, which are now used by pension funds all over the world, grew the fund to $500 billion at the end of 2021, and established CalPERS as a force in corporate governance, as well as creating standards for responsible investing to combat climate change and support sustainable returns. I'm also proud to have been, as you mentioned, the first African-American elected to the board as a member and vice president and president. And that goes to the point that representation matters in our workrooms, classrooms, and boardrooms. It is that charge, representation of over 2 million members and retirees that I hold dear. I have had the privilege of not just serving, but meeting thousands of members and retirees at conferences and coffee shops all over the past 14 years. I saw my role as threefold: to listen, to learn, and to act on questions, concerns, and ideas. While at times there were many that may have been differences in approach, there was always a shared goal to maintain retirement security for California's public servants. This work could not have been possible without the staffs of all of the departments at CalPERS, and especially our board services unit. For a decade and a half, they've provided the outstanding support in taking care of everything from developing documents for presentations and to meeting briefings. This is hard work, challenging work, but it's rewarding work, and especially when what's top of mind are the members and retirees of CalPERS. In 2008 and 2009, we saw the tanking of the global economy and a worldwide recession, a black swan event, as I referred to it. Not because recession and downturns don't ever occur, but it was unexpected and unanticipated. The COVID pandemic was such a circumstance. While we are not out of the woods entirely, it is because of the investment decisions CalPERS has made that the pandemic was not as devastating as it could have been. So over the coming years, there will be ups and downs, black swans and bull markets. As you lead and navigate these challenges and opportunities, I wish all the best and will continue to root for your success and that of CalPERS. Thank you very much, Madam President Taylor.
Thank you, Mr. Jones. That was wonderful. And we all miss you and hope to see you sometime in person.
We look forward to it one of these days, hopefully.
Hopefully.
Okay.
All right. Take care.
Okay. Bye-bye.
Yay.
Thank you. Okay.
This concludes my report, and I'm going to turn it over to Ms. Frost for her CEO report.
Great. Thank you, President Taylor, and good afternoon, everyone. On behalf of the executive team and really the entire CalPERS organization, we'd like to thank Mr. Jones for his leadership and his service to CalPERS over the last 14 years. I appreciated Ms. Taylor's comments. I certainly appreciated Mr. Jones's comments about what the last 14 years, his contributions, what he was paying attention to, and really what he was most proud of, and that was serving the 2 million members, not just the retirees who vote for the election in that seat, but his responsibility to serve all 2 million members of the system. And just on a personal note, I just say that it's been a real joy working with Henry for the 5 years that I've been here as well. I think he's been a really good partner to me, been a good partner to the organization, and we wish him all the best in health, as well as, we know he's not really going to retire. He's much too busy and needs that intellectual outlet. So hope to see him again very, very soon. Next, I'd like to just build on a few comments that were made about Black History Month and our focus on healthcare. As a pension fund that's serving 2 million members and also being the second largest health purchaser, CalPERS has a responsibility to acknowledge when inequities exist when we see them. And I believe we also have an obligation to take action on the data that's coming our way. Healthcare is certainly one of the areas where we can have pretty significant impact. The pandemic has highlighted disparities that exist for Black members and other minority groups in the health system. You heard in last month's board education that we're working with Covered California, as well as the Department of Managed Healthcare. And that those initiatives are really to enhance access to care, at least for the 1.2 million covered lives that we have in our plans. This would and should heighten our ability to negotiate with our own health plans to ensure our members can receive the specific kind of care that they need to improve health outcomes. It's a good first step, and we know there's more work yet to be done. We've also seen the difference that our diversity, equity, inclusion, or DEI work can have on our own culture here at CalPERS, our workforce, our customer service, and really the experience that our members have with our team, as well as the health and the pension programs that we provide to all of our members, as well as to their families. Black History Month is a time to learn about, as well as to celebrate the accomplishments to fellow Americans who overcame adversity. And it reminds us of the opportunities we have to evaluate our own work to this end. It is work that requires openness and accountability, which happen to be two of our CalPERS core values. On that note, I'm also happy to announce that our annual commitment to diversity, equity, and inclusion report is now posted online on our public website. It showcases the workplace demographics and highlights the work being done by a number of people here in the organization on the key initiatives out of our DEI framework, which focus on culture, talent management, health equity, supplier diversity, and of course, investments. In the coming year, we will develop DEI measures, benchmarks, and initiatives that will be reflected in our 2022 through 2027 strategic plan, which you will hear about a little bit later. Just a moment. All right, so now on to some investment performance. To this month's agenda, yesterday's meetings, as well as this morning's meeting. Earlier today, you did receive an update on our total fund investment performance that shows a calendar year return of 13.3%, which is about 120 bits or basis points above the benchmark, the relative benchmark. That's attributable to the key factors that were certainly discussed with you by your independent investment consultants, as well as from our investment team. Next month, we'll begin the implementation of the new strategic asset allocation that was adopted by all of you just last November. And we will have a series of items coming through the investment committee starting in March. And that does bring me to the presentation of the next 5-year strategic plan. You'll receive a first reading later in this agenda, just in a very short period of time from now. And just to give you a bit of background, our teams have engaged with a number of stakeholders to gather their input, their comments, their perspective on where they see opportunities, where they see risks for CalPERS in the next 5 years. We were able to take all of that feedback, including feedback done from a direct session with the board about your perspective and what you see as the key strategic threats, opportunities, weaknesses, and what you want to see the organization move more toward in the next 5 years. Again, all that data was collected, it was summarized and validated over the last few months. And then that feedback was taken to develop our high-level strategic goals, the objectives, as well as how we will measure our success in implementing those strategies. Sabrina Hutchins of our Enterprise Strategy and Performance Division will present the details of that plan here just shortly. If approved, again, this is an information item today, but if approved, the new strategic plan would go into effect on July 1. And then just quickly before I conclude, I'd like to thank the board and all of our stakeholders who participated in our 3rd annual stakeholder forum. That was another virtual event. I think it went very well. The stakeholder reviews and comments indicated that they thought the content was appropriate, that it was relevant, and certainly are looking forward to being able to do this in person next year, but thought this was a nice replacement for an in-person event. And then let me end with a few personnel updates. As many of you know, this is Ann Simpson's last week with CalPERS. She will be joining Franklin Templeton as its head of global sustainability. Ann's work over the last 13 years has left really just a significant mark on our sustainable investment strategies. which have significantly helped to reduce climate-related financial risks in our own portfolio, really leading some of the TCFD report or creation of that report that we did here in CalPERS. Among so many important accomplishments for her. She's been a strong advocate for corporate governance reforms in our financial markets, really a leader of many critical investor coalitions, including Climate Action 100+, of which CalPERS was a co-founder, and has worked diligently to help create uniform climate reporting standards, including helping with the new Climate Action 100+ benchmark. Her contributions go far beyond her work in our own investment office. She's been an integral part of conversations across the organization that have helped solidify that CalPERS' cultural values in our work with diversity, equity, and inclusion. She was a key contributor to our own creation of the DEI framework. She'll be greatly missed. She'll be greatly missed for her humor. She'll be greatly missed for her intellect, her ability to communicate very complex topics to a wide variety of audiences and get a little bit of a laugh from everyone who she presented to. We're really grateful for her service to CalPERS and wish her well in her new role at Franklin Templeton. James Andrus, who's been a key leader in our sustainable policy work, will serve as the interim managing investment director for board governance and sustainability, and we will do a global recruitment for that position. And then we also have a new addition to the team I wanted to mention. You were all introduced to him at the Risk and Audit Committee meeting yesterday. Kevin Fine joined us earlier as our new Chief Compliance Officer. He comes to us with more than 35 years experience in the financial services industry, working in senior compliance positions for organizations like Citizens Bank and TD Bank. We're using his opportunity as an opportunity, or using his appointment as an opportunity to consolidate some of our integrated assurance programs, including audit, risk, and compliance. But I'd also like to thank Warren Alsiford for serving as the interim Chief Compliance Officer. He and the team just did remarkably well, both under Warren's leadership, but just the amount of work that they have been able to accomplish in an interim role and in overseeing that work is just outstanding, and wanted to take a quick moment to thank him as well. And so that does conclude my report for this month, and I'm really happy to take any questions.
I don't think I'm seeing any questions, Ms. Frost. Thank you very much. With that, we will move on to agenda item 6, the action consent items. As we have done for the day, I'm going to pull them apart. So we have 6A and 6B. Do I have a motion?
Move approval.
Moved by Mr. Miller,
Second.
seconded by Ms. Paquin. So we're moving approval of 6A. Ms. Hopper.
Rob Fechner,
Aye.
Frank Ruffino for Fiona Ma,
Aye.
Lisa Middleton,
Aye.
David Miller,
Aye.
Arena Ortega,
Aye.
Jose Luis Pacheco,
Abstain.
Ramon Rubalcava,
Excused.
Shonda Wesley,
Aye.
Lynn Paquin for Betty Yee.
Aye.
Madam President, I have a motion being made by David Miller, seconded by Lynn Paquin for Betty Yee on agenda item 6A, approval of the November 17th Board of Administration meeting minutes. I have all ayes, 1 abstention from Jose Luis Pacheco.
All right, thank you. Motion carries for 6A. 6B, do I have a motion?
So moved.
Moved by Mr. Miller, seconded by Mr. Pacheco. Ms. Hopper?
Rob Fechner,
Aye.
Frank Ruffino for Fiona Ma,
Aye.
Lisa Middleton,
Aye.
David Miller,
Aye.
Arena Jose Luis Pacheco,
Aye.
Ramon Rubalcava.
Excused.
Shonda Wesley,
Aye.
Lynn Paquin for Betty Yee.
Aye.
Madam President, I have a motion being made by David Miller, seconded by Jose Luis Pacheco. All ayes, 1 excuse for Ramon Rubalcava on agenda item 6B, board travel approvals.
Great, thank you. Agenda item 7B carries. We are on, I'm sorry, 6B carries. We are on agenda item 7, which is information consent. And I have not received any requests for pulling any of the information items off, so we're going to move on to 8, committee reports. And with that, I'm trying to think. Oh yeah, I have to remember who's chair now. With that, I believe our first committee report is from Ms. Middleton for Finance Administration Committee.
Madam Chair, I believe it'll be starting with investments.
I'm not seeing investment yet. Come up. Okay, I will start with investments. Do we have, does Mr. Miller have his investment committee notes? You're on mute, Mr. Miller.
Okay, I'm just trying to make them large enough for me to see. Okay. The investment committee met on February 15th, 2022. The committee held an election for chair and vice chair positions. David Miller was elected chair and Rob Fechner was elected vice chair. The committee received reports on the following topics: a review of market conditions and CalPERS performance from the board's investment consultants, a staff review of performance and risk positioning across CalPERS funds, investment and business functions, and economic conditions, an update on global equities, corporate governance, and proxy voting work streams. The chair directed staff to provide a response to a public comment regarding questions on proxy voting, prepare information in response to a committee member request regarding human capital management and its relationship to investment returns, and provide a response to questions from a public commenter regarding the year-to-date investment returns and the fiscal year outlook. The committee heard public comment on the following topics: a legal dispute, proxy voting strategy, investment strategy, and investment performance. At this time, I'd like to share some highlights of what to expect at the March Investment Committee meeting. An educational panel discussion on the topic of emerging markets, an overview of proposed policy portfolios for the affiliate funds, the first reading of proposed revisions to the total fund, global fixed income, private equity, and real assets policies, and information regarding the selection of the board's private debt consultant. The next meeting of the investment committee is scheduled for March 14th, 2022 in Sacramento, California. That concludes my report, Madam Chair.
Thank you, Mr. Miller. 8B is pension and health, and we do not have a report for pension and health. 8C, Ms. Middleton.
Thank you. Give me just a moment to pull that up. My apology, we had some confusion here as to where the report was. All right. The committee held the Finance and Administration Committee met on February 14, 2022. The committee held an election for the Finance and Administration Committee chair and vice chair. Lisa Middleton was elected chair and David Miller was elected vice chair. The committee recommends, and I move, the board approve the following. Agenda item 7A, approve the 2022 CalPERS Board of Administration state, school, and special retired member elections, notice of election. Agenda item 7B, approve board member employer reimbursement amended of the proposed board member percentages of time to be spent on board-related duties on board and committee selections effective January 18, 2022.
All right, on motion by committee, any discussion on the motions? All those in favor, Ms. Hopper?
Rob Fechner,
Aye.
Frank Ruffino for Fiona Ma,
Aye.
Lisa Middleton,
Aye.
David Miller,
Aye.
Elena Ortega,
Aye.
Jose Luis Pacheco,
Aye.
Ramon Rubacava,
I'm sorry, excused.
Shonda Wesley,
Aye.
Lynn Packman for Betty Yee.
Aye.
Madam President, a motion has been made by Lisa Middleton for agenda items 7A and 7B from the Finance and Administration Committee.
Thank you, Ms. Hopper. Motion carries. Ms. Middleton, go ahead and continue.
Thank you. The committee reviewed the FAC delegation and has no recommended changes. The delegation will be presented for board approval along with other committee delegations at a subsequent meeting. In addition, the committee received a report on the 2021 CalPERS Board of Administration member-at-large election results. The chair was directed to follow up with Mr. McRitchie on his question from public comment. At this time, I would like to share some of the highlights of what to expect at the April Finance and Administration Committee meeting. 2022-23 annual budget proposal, annual review of board member employer reimbursements, state valuation, and employer-employee contribution rates, school valuation, and employer-employee contribution rates. The committee heard public comment on the following: the 2022 CalPERS Board of Administration State School and Special Retired Member Elections Notice of Election, 2021 CalPERS Board of Administration Meeting at Large Election Results. The next meeting of the Finance and Administration Committee is scheduled for April 18, 2022.
Thank you, Ms. Middleton. Our next agenda item is D, Performance Compensation Talent Management Committee. And for that, I believe I'm calling on Mr. Beckner. No.
That's correct. Thank you, Madam Chair. The Performance Compensation Talent Management Committee met on February 14th, 2022. The committee held an election of the Performance Compensation Talent Management Committee Chair and Vice Chair. Rob Fechner was elected Chair and Elena Ortega was elected Vice Chair. The committee recommends that I move the board approve the following. Agenda item 8A, semi-annual status report on the incentive plan of the Chief Executive Officer. Approve the fiscal year 2021 to 22 semi-annual status report of the Chief Executive Officer.
Motion by the committee. All those, any discussion on the motion first? All right, I see no discussion on the motion. So all those in favor, Ms. Hopper.
Rob Fechner,
Aye.
Frank Ruffino for Fiona Ma,
Aye.
Lisa Middleton,
Aye.
David Miller,
Aye.
Elena Ortega,
Aye.
Jose Luis Pacheco,
Aye.
Ramon Rubacava,
Excused?
Shonda Wesley,
Aye.
Lynn Packman for Betty Yee.
Aye.
Mr. Chair, I have a motion being made by Rob Fechner. All ayes with an excuse from Ramon Rubacava on agenda item 8A of the Performance Compensation and Talent Management Committee.
Thank you. Motion carries. Mr. Fechner.
Thank you. The committee also reviewed the PCTM delegation and has no recommended changes. The delegation will be presented for board approval along with other committee delegations at a subsequent meeting. The committee received reports on the following topics. A, report on market compensation data covering statutory positions. The chair directed staff to continue to work with McLagan and Global Governance Advisors to bring back additional compensation data and options for consideration by the committee. At this time, I would like to share some highlights of what to expect at the next PCTMC meeting. The committee will receive a report on the annual review of incentive metrics for fiscal year 22-23, and the board's consultant will provide an educational session and review of our compensation policy. The next meeting of the PCTMC will be April 19th in Sacramento, California. Thank you, Madam Chair.
Thank you, Mr. Fechner. Item 8D, I'm sorry, E is Risk and Audit Committee. And for that, I call on Ms. Middleton again.
Thank you, Madam Chair, President. The Risk and Audit Committee met on February 14, 2022. The committee held an election for the Risk and Audit Committee Chair and Vice Chair. Lisa Middleton was elected Chair. David Miller was elected Vice Chair. The committee also reviewed the Risk and Audit Committee delegation and had no recommended changes. The delegation will be presented for board approval along with other committee delegations at a subsequent meeting. The committee received reports on the following topics: the Enterprise Compliance and Enterprise Risk Management 2021-22 mid-year plan updates, the third-party valuation and certification of the 2020 CalPERS annual valuation of public agencies. At this time, I would like to share some of the highlights of what to expect at the April Risk and Audit Committee meeting, the 2021-22 Enterprise Compliance and Risk Management Plans. The next meeting of the Risk and Audit Committee is scheduled for April 18, 2022 in Sacramento, California. Thank you, Madam President.
Thank you, Ms. Middleton. And with that, we are moving on. And of course, my iPad closed. That finishes up our committee reports and actions. We are, board governance did not meet this month. We are moving on to action agenda items 9A. And for that, or 9, for that I call on Mr. Fechner, Vice President Fechner.
Thank you, Madam Chair. I move that the board adopts the proposed decisions of agenda items 9A1 through 9A3 and 9A5 through 9A7, with the minor modifications argued by staff to agenda items 9A5 and 7. And in addition, schedule agenda item 9A4 for a full board hearing as argued by staff.
Thank you, Mr. Fechner. On the motion by, do I have any discussion? Mr. Miller.
No, I was just seconding.
Oh, thank you. Second is Mr. Miller. Mr. Fechner made the motion. Ms. Hopper.
Rob Fechner,
Aye.
Frank Ruffino for Fiona Ma,
Aye.
Lisa Middleton,
Aye.
David Miller,
Aye.
Irena Ortega,
Aye.
Jose Luis Pacheco,
Aye.
Ramon Rubalcava,
Excused?
Shonda Wesley,
Aye.
Lynn Paquin for Betty Yee.
Aye.
Madam President, I have a motion being made by Rob Fechner, seconded by David Miller. All ayes with an excuse from Ramon Rubalcava for agenda item 9A for proposed decisions of administrative law judges.
Thank you. And motion has carried. Mr. Fechner? Did you do 1 and 2?
I did.
Okay. And that moves us on to agenda item B, 10, which is first, we're going to start.
Give a 9B. Mr. Jacobs.
There is a 9B. Go ahead, Mr. Jacobs.
All right. Good afternoon, board members. I think this item should be pretty straightforward. You may recall that last June, you established a pool of 3 law firms as our fiduciary counsel for CalPERS. And then, of course, that was subject to negotiating contracts with each of those firms. One of those firms had conflicts that we were not comfortable moving forward with. And so we're now proposing that we sub in the Olson Remcho firm for the firm with the conflicts, Hanson Bridget, to fill out that pool of 3 that you had opted for back in June and in a previous board meeting where you discussed various options about how to proceed with fiduciary council pool. I think Olson Remshow would be a good fit. One of its primary attorneys on the matter would be the former the former GC of STIRS. And the firm is also in the fiduciary council pool for STIRS and Lacers and Lacera and several others. And it has a good value point on their fees. So happy to answer any questions, but that is staff's recommendation, is that we sub in Olson Remcho for Hanson Bridget. Subject, of course, again, to negotiating a contract with Olson Remcho.
And Mr. Jacobs, Olson Remcho was the fourth up the running.
It was.
Okay. So this is an action item. Can I have a motion? Oh, I've got Mr. Miller, go ahead.
Oh, I was gonna make a motion or second the motion or.
Okay, so Mr. Miller makes a motion. Mr. Fechner, did you have questions?
I will second the motion.
Okay, we have the motion to approve adding Olson Remcho, subject to contract negotiations, to the new external fiduciary council pool in place of one of the firms the board had previously selected. It has been made by Mr. Miller, seconded by Mr. Fechner. Ms. Hopper.
Rob Fechner,
Aye.
Frank Ruffino for Fiona Ma,
Aye.
Lisa Middleton,
Aye.
David Miller,
Aye.
Irene Ortega,
Aye.
Jose Luis Pacheco,
Aye.
Ramon Rubicava,
Excused.
Shonda Wesley,
Aye.
Lynn Paquin for Betty Yee.
Aye.
Madam President, I have all ayes with an excuse from Ramon Rubicava. Motion being made by David Miller, seconded by Rob Fechner for agenda item 9B, fiduciary council pool.
Thank you. Motion carries. Mr. Jacobs, thank you very much.
Thank you.
All right, so now we move on to agenda item 10A, state and federal legislative update. Is that Danny? Did we move too fast?
President Taylor, Mr. Brown is coming into the room now.
Okay. Give us a minute.
Sorry about that.
That's
Here I am.
okay.
Good afternoon, Madam President and board members. Danny Brown, CalPERS team member. This item is the state and federal legislative update. On the state side, the legislature reconvened in January to begin its work for 2022. As the second year of a two-year session, January 31st was the deadline for two-year bills to pass their House of Origin. At the same time, legislators started introducing new bills, and the governor released his budget proposal on January 10th. For the two-year bills facing the January 31st deadline, I'll mention a few. First, as has been covered extensively in the press, AB 1400 by Assemblymember Calra, which would have created the statutory framework for a universal single-payer healthcare system, was not brought up for a vote on the Assembly floor, so it did not meet the deadline. In addition, AB 1019 by Assemblymember Holden, related to divestment from the Republic of Turkey, and AB 1092 by Assemblymember Mays, related to limitations on retiree healthcare, were not set or heard in committee, so both those bills failed to meet the deadline also. Regarding the governor's January 10 budget, the top line item for CalPERS was the proposed supplemental payment of $3.5 billion for state employee unfunded liabilities. This item is scheduled to be heard in Assembly and Senate budget committees in March. And so we will continue to monitor this and any new proposals that may come up as the budget process moves forward. Moving on to new bill introductions. The deadline for new bills is this Friday. You can expect over 2,000 bills to be introduced. Through yesterday, though, there's only been 720 new bills introduced, so we can expect another 1,300 to 1,500 bills introduced over the next 4 days. So our team will be busy reviewing those bills, beginning to identify those that impact CalPERS operations, members, and employers. As shown on your bill list, we have already identified a few new bills impacting CalPERS. SB 835 by Senator Newman proposes to provide up to 120 days of healthcare coverage for the families of legislative employees that die while in active employment. This is the same coverage that state employees currently receive. SB 850 by Senator Laird proposes to provide the additional special death benefit to the person with custody of the deceased member's children in cases where there is no surviving spouse of the member. The special death benefit is paid when a safety member dies in the line of duty due to a violent act. And then since the bill list was created, there has been one more bill introduced that I will mention, AB 1722 by Assemblymember Cooper, and this relates to provision of the PEARL that provides the higher of 3 industrial disability retirement options, including an actually reduced benefit for those under age 50. The current provision is set to sunset on January 1st, 2023, and this bill would remove the sunset clause, making the provision permanent. Finally, the Senate Labor Committee and the Assembly PERS Committee are scheduled to have a joint information hearing on March 9th. This hearing is intended to meet the statutory requirement for the California Actuarial Advisory Panel, known as CAP, to report to the legislative policy committees each 2-year legislative session. In addition to the CAP presentation, CalPERS, along with other retirement systems, have been asked to provide an update on upcoming challenges and opportunities. And with that, I will switch to the federal update. And let me start with some activities since the last board meeting in November. We have submitted a total of 4 comment letters and signed on to 2 group letters. We sent 2 comment letters to the SEC. The first was in support of a proposed rule related to erroneous awarded executive compensation recovery standards, otherwise known as clawbacks. The second one urged the SEC to fully rescind the proxy voting advice rule adopted in 2020 under the prior administration. We also submitted a comment letter to the Department of Labor, welcoming the positive moves made on a proposed rule related to ERISA plans ESG investing considerations, but also encouraged them to take further action to improve upon the framework, to more closely apply common law concepts of fiduciary duty and updates its approach to align with modern investing. Our last comment letter was sent to the Centers for Medicare and Medicaid Services on requirements related to surprise medical billing. In this letter, we voiced our thoughts on the arbitrated payment amount and the independent dispute resolution process, with our focus on mitigating future premium increases. Moving to the 2 letters that we signed on with other institutional investors. One called on the Biden administration to rapidly advance methane regulations for the U.S. oil and gas sector. And the second one went to the SEC, supporting its plan to develop proposals for consistent, comparable, and decision-useful disclosures addressing human capital management. All of these letters can be found on our external website. Now, looking ahead, most of our activity in the near term will continue to be on the regulatory side. Last week, SEC published proposed rules around the private markets that we are currently reviewing, and we are also anticipating the release of the climate-related financial disclosures along with human capital management disclosures. And I anticipate that we will be commenting on all of these proposals in some form or fashion. And with that, I'm happy to stop and answer any questions that you have on state or federal.
I'm not showing anybody with questions. Let me make sure I'm not missing hands. Mr. Brown, but the last thing you mentioned, the SEC rules on private equity, do you have any idea what our stance around that's going to be? I know there's several organizations commenting already or preparing comments.
Well, it came out last week. It's over 300 pages. I know Greg Ruiz and his team is reviewing. So I mean, obviously we're supportive of more transparency, but I think as the team looks at the details of it, we'll have a better sense of what our plans are as far as commenting.
Okay, great. I'd love to hear the report on that. Thank you. And I still don't see any more questions, so I guess we will move on to 10B, Strategic Plan, CalPERS 2022 to 2027 Strategic Plan. And for that, who am I moving to, Ms. Frost?
We should be promoting Sabrina Hutchins.
Okay, she's not. There she is.
Hello there, everybody. Can you hear me?
Yes, thank you. There you are.
Awesome. All right. Well, good afternoon, Madam President and members of the board. My name is Sabrina Hutchins, Chief of the Enterprise Strategy and Performance Division, CalPERS team member. I'm excited to be here today to share our progress to date with much anticipation to bring our next strategic plan to life. We consider this a first reading of the 2022 through 2027 strategic plan, and we want to give the board another opportunity to share any additional feedback since the last time we met. Ideally, the goal is to finalize the plan before the end of the fiscal year when the current plan ends. We will seek your approval of the plan at a second reading over the coming months in anticipation of this new plan in July of this year. Next slide, please. So through our discussion today, I will be reviewing the original project scope and timeline. I want to bring everybody up to speed and also highlight what we've accomplished to date, and then begin to review each strategic goal, objective, as well as highlight our strategic measures that we will use to gauge our progress over the life of the plan. We are looking for your insight and feedback here. Do you see any gaps? Are we on the right track? Our executive team is also standing by to help facilitate these discussions, to share their strategic insights, and to answer any questions you have. Next slide, please. CalPERS embarked on a thoughtful approach to developing our next 5-year strategic plan almost 2 years ago. This view outlines our high-level project timeline and opportunities of engagement with you as the board, as well as our stakeholders. Some of you may recall we kicked off our efforts back in July of 2020 by sharing this timeline and the steps in our planning process. Last time we met on this topic, I facilitated an interactive discussion that we held in July of last year, 2021. We gathered your input on the high-level goals and objectives that we were proposing. Based on your feedback and overall positive consensus to continuing our efforts, we facilitated additional refinements to the plan by working with our program experts and executive team. And now we have also added our strategic measures to further demonstrate accountability and transparency. So throughout this project, we have engaged with internal and external stakeholders to get to where we are today. Again, our goal is to have our plan ready to implement on time in July of 2022. And having our strategic plan in place is very important to CalPERS, as it clearly articulates our strategic priorities and focus that keeps our team members moving forward and delivering on our mission. Next slide, please. CalPERS sponsors a comprehensive strategic planning process and framework. Our vision and mission provides insight to our aspirations and clearly states our purpose for existence. Our strategic goals communicate what we want to accomplish over the long term. Our objectives clarify how we will achieve these stated goals, and our measures provide meaningful progress indicators. These top 4 layers typically stay consistent over the life of the plan, and these are the areas that we are focused on with you today. The bottom layer of our framework here is our business plan initiatives, and these articulate the work we will undertake to help us achieve our goals and objectives along the way. Again, our strategic plan typically stays intact over the life of the 5-year time horizon, and our business plan is refreshed each year to adapt to changing situations, to help us mitigate any barriers, and to stay in pursuit of our mission and vision. As an additional reminder, we do report on all of these components to the Board of Administration directly through our Insight tool and the CalPERS website for the public on a quarterly basis. Next slide, please. The CalPERS team considered many inputs to frame up and build this plan. It's always important to take a fresh look at your vision and mission at the beginning of a strategic planning process. And for us, our aspirations and purpose has not changed. Our vision is that we want to be a respected partner, providing a sustainable retirement system and healthcare program for those who serve California. And our mission is to deliver retirement and healthcare benefits to our members and their beneficiaries. Based on this understanding, we saw our efforts for the strategic plan to be more of a refresh and an expansion of the current plan we have in place. And we did leverage several components of our current plan to build upon. We evaluated our internal business operations and strategic performance. We analyzed our external environment, including a peer review, and we considered the enterprise risk assessment data. We conducted several surveys with our internal team, hosted many external stakeholder interviews, senior leadership discussions, and heard feedback from the board. All of these inputs brought us to the 5 key focus areas of the strategic plan moving forward that include the member experience, pension sustainability, exceptional healthcare, stakeholder engagement, and organizational excellence. And we will review all of these goals in more details in just a moment. We believe this plan articulates a comprehensive outlook to achieving our mission that demonstrates accountability, engagement, and transparency. Next slide. So before we dive into the first goal, a few reminders for facilitation structure and material reference. My role will be to summarize our intent of the goals, how we will achieve these goals, and our proposed measures to gauge our progress. At the end of my summary of each goal, I'll open it up for any questions and dialogue and ask our executive team to join in for the discussion. Our expectations with you today are not necessarily to do wordsmithing on the spot, but to ensure we are clearly communicating our intent, that we're identifying if we missed anything, and gathering your feedback overall. As I mentioned in the introduction, we last met in July, where we reviewed these proposed goals and objectives. And based on your feedback and consensus to move forward, we facilitated additional refinements to the plan. And now again, we've added our strategic measures. Now, most of these measures we do have in place today, or we have access to data through our enterprise reporting framework. Some of these measures will initially be under development over the coming months and the first year of the plan. However, we have identified key data points and data sources. All of our materials are in draft form today, as this is a first reading. We expect additional refinements and building from here to further finalize this plan. The PowerPoint layout is a high-level guide to help us facilitate our discussion, and more of the details to each of the measures can be found in attachment 2 and 3. The way the slides are laid out is you have your goal to the left. The objectives are stated in the top boxes, and the measures are listed below each box. So with that said, I'm going to start, but before I dive in, I just wanted to open up for any questions or comments.
Mr. Miller.
Hi, it's just a very minor thing, but in the mission statement, I always like to look at mission statements and be able to immediately know whose mission statement it is. So CalPERS members might be something to consider. Other
Hold on. If anybody else has any questions, I need you to put it in the chat because I can't see everybody's hands. I'm not seeing anything.
All right, very good. So then with the member experience goal, and I'm just queuing up to our executive team as they're relevant to these goals. So again, member experience. We exist to serve our members, and they are at the forefront of our strategic priorities. The member experience goal will serve to ensure member satisfaction through accuracy, responsiveness, and respect. And we will demonstrate this through the following objectives. We want to deliver accurate benefits to our members and their beneficiaries. We want to ensure that our members and beneficiaries receive benefit payments on time, and that we provide timely responses and appropriate action to our inquiries. And we also want to enhance our services, communication, and education to our members, for our members along the way. So we do currently collect data to measure performance on the accuracy of payments and the benefit payment timeliness, being this is one of our most critical functions, as well as customer satisfaction data to ensure we are listening and taking action on their feedback. So during our last discussion, we didn't have any significant feedback with the board. Overall, this goal looked good. We did have a question from the board around measuring benefit accuracy. And as I just mentioned, in the summary, we do address that as one of our proposed strategic measures. And again, we do have data on that element that's been in place for quite some time. So with that, I will stop here and open up for any questions or comments.
Again, I can't see everybody, but I'm not seeing any right now, Sabrina. So I guess you can go ahead.
Very good. All right. So the next goal we have up is focused on pension sustainability, specifically to strengthen the long-term sustainability of the pension fund. Our 4 key objectives here to obtaining this goal are to balance the cost of future pension payments with the expected future investment risk and return through the asset liability management process. We want to mitigate the risk of significant investment loss while balancing contribution levels and volatility, and deliver risk-adjusted investment returns to meet or exceed the expected rate of return, and also to integrate sustainable investment strategies. So we will continue to utilize several measures that are aligned within our current strategic plan today, and that includes the funded status, total expected fund volatility, the annualized 5-year excess investment returns related to the total fund policy benchmark. And then we plan to add data points related to our employer contribution rates, tracking these trends over time. And then we have several measures under development related to the sustainable investment strategies. And our goal here is to communicate data around % of diverse managers by identifying diverse firms in the portfolio and other key elements of diversity in the workforce. Also, through the human capital management initiatives, we want to promote greater diversity of corporate board members and influence other key areas related to human capital. We heard about some of this today earlier in the investment committees. We have set targets related to net zero by 2050, focusing on climate solutions and clean energy and a just transition, as well as influence and engagement with legislators and regulators regarding financial market policy in line with our governance and sustainability principles. So last time we met with you, we received feedback from the board around clarifying the objective language related to the ALM activities, having a stronger emphasis on employer affordability concerns, and the suggestion to combine a couple of the objective statements in relationship to risk of investment loss and addressing contribution levels and volatilities. And we did address these items as I just summarized. So with that, I will open it up for questions and comments.
I don't think I see any questions again, but I just want to make sure as we're moving through this 5-year plan, and I know I've spoken to Ms. Frost about this, that the Sustainable Governance Group is also working on their 5-year plan. I just kind of want to make sure of that goes kind of hand in hand with this, right?
Yes, it does. And we did work with that team that aligns to all of those planning activities.
Great.
Wanted to expand on that, Marcy.
Yeah, I was going to say, yes, President Taylor, these are the elements out of the 5-year sustainability plan. So they should and probably do look quite familiar to you.
Yes, they do. Okay, so I wanted to make sure because I know that hasn't been presented yet, the new one. So as we move forward. So no, I guess I'm still looking. I don't see, I don't see anything else. So go ahead, Sabrina.
Great, that's a great sign. There's been a lot of work put into these since our last visit. So this is great news. Thank you.
Mr. Hoffman asked, did I miss this? Can the slide be advanced?
Oh.
Did we miss something?
We just finished pension sustainability and we're getting ready to advance to healthcare. If there are no questions on pension sustainability, and I think we're good. All right. So the exceptional healthcare goal will ensure our members have access to equitable, high quality, and affordable healthcare. This is reinforced through each of the strategic objectives. Ensuring our members receive high quality healthcare that they have access to care when and where they need it, that the care is affordable, and that our members receive equitable care. We will measure our progress through several key metrics. We have the chronic disease prevention and management measure that utilizes 3 of the healthcare effectiveness data and information sets, also referred to as HEDIS. These are focused on diabetes care for the hemoglobin A1C management, hypertension, controlling high blood pressure, and obesity counseling. We also have the behavioral health prevention and treatment that utilizes 3 of the HEDIS measures focused on depression management, mental health care, acute care follow-up, and substance use treatment and engagement. The healthcare member experience measure represents the percentage of members who rate their care as positive. And the access to care measure provides the percentage of members responding that they have received routine care as soon as they needed it. The healthcare affordability measure evaluates the year-over-year change in total premium costs for the CalPERS health benefit program against a benchmark trend. Now, all of these measures highlighted so far we have in place today. And then the Achieving Healthcare Equity is a new measure under development where we plan to utilize data from a health equity index created by our internal health team. So last time we met with the board, we received feedback around having a specific objective focused on equity. And as summarized, we did make that adjustment. So with that, I will open it up for any questions.
So I do have a question. Let me start with your healthcare affordability is measured by a benchmark. What is that benchmark? And are we looking at the inflation? I mean, now that inflation is so high, it's not as bad as it used to be, but the inflation comparison between healthcare and other products, right, which is so much different. It's really disparate, but also that also translates into our members not being able to afford the healthcare. So what is the benchmark exactly?
So I'll ask Dawn to step in and help out here. I believe it's an industry experts for an external consulting firm is where we get the benchmarking from, but is Dawn available?
Sorry, are we, can folks hear me?
Yes.
Great. So the specific benchmark that Sabrina was mentioning is a benchmark that we use to measure our premium growth over time. And we benchmark both nationally and within California. We also, among the other strategies under this goal is one to try to bring down the cost of care to our members outside of just premium. And so as an example, when the board approved the expansion of the EPOs into 11 rural counties, as you all know, EPOs have significantly lower cost sharing than a PPO. So that was one of the things that we did to try to make the healthcare more affordable to our individual members. But in terms of the benchmark for that goal, the key benchmark is the benchmark we use when we look at premium and how well we're doing against the market. We don't use general inflation because it is just so different than healthcare inflation. It tracks to a certain degree, but not perfectly.
It sounds like you have other things you're doing underneath that as well.
That's correct.
For the affordability, and we'll probably, I'm sure, as you come forward with progress reports, hear more about that. Then my other question, I don't know if Dawn needs to leave yet or not, is achieving health equity. You had said that that was added and you're working on flushing that out. So when that happens, are we going to bring that forward for what that exactly means for us, for each of the communities that we're serving, whether it's our BIPOC community or LGBTQ plus community, et cetera?
Yeah, sure. I can at least start on that. We're happy to come back and have a broader conversation about health equity. But when we came forward, as Sabrina mentioned, when we came forward last year, we had just we had started on the work on health equity, which is a major part of what we're doing now. And, key initiatives included this initiative that Sabrina mentioned, to collect demographic information on our members on a voluntary basis so that we can do analysis to see potential disparities within our membership. We are also looking at the literature, so we have we have an understanding of what we're likely to see in our members, but we want to know specifically about their experience. We have the focus on health equity. We've always thought about health equity, but the targeted focus is newer work to us. It corresponds to the work of the broader enterprise. The more that we talk about what we do and the more we learn about health equity, the more we have come to understand and appreciate how essential it is to everything we do, to affordability, to quality, et cetera. So, as Sabrina said, we had it built into all of these work streams, but we also wanted to elevate it. It's an important signal to our external partners. It's an important reminder to ourselves and to our team that it's of high importance, and that unless we succeed in making our benefit equitable, we can hit a lot of these measures, but not ultimately accomplish what we're trying to accomplish. So that was the thinking about elevating it to a fourth goal, as a fourth goal.
I appreciate that. Thank you very much. And I was hoping to give time for other questions. And I'm seeing none. So I guess we can move on, Sabrina.
Very good. Okay, next slide.
Oh, wait, I'm sorry, Mr. Jose and Luis Pacheco, go ahead.
Thank you.
And if you guys can comment, because I only have a little corner and I have to scroll through to see people. So if you can just put in here, you have a question, that would be helpful.
I apologize, Madam President. Just want to ask you a question regarding back at the previous slide regarding the chronic disease prevention and management. I believe you mentioned the top three were diabetes, high blood pressure, and I think it was obesity rates. But I wanted to know, how did you come about that, or yeah? I just wanted to verify that. Thank you.
Yeah. So and this is actually also the conversation we had back in January when we had Department of Healthcare Services and Covered California join us. It's part of what we've been working on with them as well. And one of the things that we've done is identified a handful of key measures across that we all agree are going to be part of our core measure. So colorectal screening is in there as well, but it's really a matter of looking at key drivers of health and where you get the biggest bang for your buck. And when I say that, I don't mean, just in terms of dollars spent, but where you can make the biggest difference in health outcomes and in ensuring people live longer, more disability-free lives. And that's how we identify them. And then they get built into the performance metrics that we use to evaluate health plan performance. We have penalties associated with them for low performers. And per the conversation we had back in January, increasingly we're thinking about how we can do a better job of pushing that information out to our members so they know who the high performers are and who's doing well in these areas.
Does that answer your question, Mr. Pacheco?
Yes, it does. Thank you very much.
Okay, thank you. Sabrina, you can go on. Thanks.
Very good. So next slide. Very good. Stakeholder engagement. This goal is focused on our stakeholders and our employers, as we want to be a collaborative and engaged partner by promoting collaboration, support, and transparency. The first objective here will focus on educating and engagement with our stakeholders on system impacts, including policy and program changes, risk, and mitigation. And the second objective will focus on enhancing our services, communication, and education tools for our partners. We will measure our progress through several data points from the Stakeholder Perception Survey, including our participation rate and insights on overall rating of CalPERS as positive, Are we doing a good job of keeping our stakeholders informed? And do we have effective functions and programs to address compliance and risk? And are our stakeholders confident that CalPERS is taking steps to reduce risk? We will also have metrics related to the effectiveness of our outreach tools through the CalPERS website. So the feedback here we received from the board last time around was around the goal title, which was a bit broad at that time. We originally came in with collaborative partner. And as you can see, we revised that to specifically call out our intent, and this is focused on stakeholder engagement. So with that, I'll open up for questions or comments.
I am still not seeing any questions or comments. These are great, by the way. I do want to compliment you guys on fleshing this out really well. So I think you can go on, Sabrina.
All right. So our final goal, next slide, there we go, is to discuss around organizational excellence. And this focuses on cultivating a risk intelligent and innovative culture through our team and our processes. This goal will be covered over the next 3 slides as we have several key objectives that support this goal. The first objective I will cover is around improving processes, operations, and advancing technologies to gain efficiencies. We will demonstrate our progress here through several measures. We have our measure related to our administrative operating costs, considering our budget and overhead expenses. The operational efficiency measure is new, and we will have this initially under development. And what this will demonstrate is accountability when we either improve a process by implementing lean practices, streamlining operations, or enhancing technology. We want to track the return on investment, such as cost savings, time savings, improved production, improved services, or changes in resource allocation. We will also maintain our CEM, which is a cost effectiveness measurement for pension administration and investment office benchmarking surveys. These give us a comparative analysis against our peer groups, and it provides us trends about ourselves over time. The second objective here that's aligned to this goal is around cultivating compliance and risk functions throughout the enterprise. So here we will continue to measure, we have measures related to employee risk and compliance awareness through a survey, data analysis, as well as our information security office items that are reported in closed session. And then we are adding 2 new measures around effectiveness for both our risk and compliance programs. These will also initially be under development. The risk component will focus on data related to incident reporting and implementation and utilization of internal controls. And compliance will focus on Form 700 and mandatory training completion rates, as well as trading violations. As you're aware, we recently appointed our new Chief Compliance Officer, and we will be working with Kevin for any potential expansions in this area over the coming months. So with that, I will open it up for questions and comments.
Okay, I'm not seeing any questions. I just want to scroll through real quick.
Mr. Miller has
his hand up.
Oh, thank you, Mr. Miller. I totally missed your screen, David.
Yeah, again, just kind of a wonky detail kind of thing, but when I think of excellence, I don't think just of efficiencies. I think of effectiveness and efficiencies, and so improving process operations to gain in efficiency or effectiveness. Efficiency alone, you can run yourself right out of business becoming more efficient. So
efficiencies and effectiveness of all of these things. So it's a dual element. We could certainly add that in. Yeah, and our outcomes around that are really about, it could be cost, it could be production, it could be, lots of different things that we're improving ultimately.
Baked in there. Thank you.
All right, point well taken there. We appreciate that feedback.
Thank you very much, David. Anything else? Anybody? That looks like no more questions from us again.
All right. Next slide. All right, so as we continue this goal, we have several more objectives, and these are focused on our people and our culture at CalPERS. They include to recruit and retain diverse talent, to enhance team member engagement and their experience, and also to integrate and sustain leadership competencies to promote behaviors that retain and engage a high-performing workforce. The measures we will utilize here that will initially be under development, including sharing key data points about our candidate outreach efforts, participation and results from our onboarding and exit surveys, and summarizing what our workforce demographics look like, and also our employee development program data. So to demonstrate progress related to team member engagement and experience, we will utilize our annual team member engagement survey results and also include the Net Promoter Score that highlights an indicator of our team members' willingness to refer others to CalPERS as a great place to work. Within the leadership competency area, this measure will initially be under development and will focus on utilization of a new competency tool and its reporting capabilities. So I'll pause here again for any questions or comments.
Oops, any comments or questions from anyone? Seeing none, Sabrina, go ahead.
All right, our final piece of this goal is a really nice highlight. It's focused on our new DE&I framework around cultivating diversity, equity, and inclusion through culture, talent, investments, health equity, and supplier diversity. What you will notice here is that these measures are in alignment with many of the prior goals that we've discussed, as we wanted to ensure connectivity throughout our strategic priorities and highlight our comprehensive reach as it relates to DE&I engagement and strategies. Specifically within this objective related to culture, the culture category, we have some additional measures aligned for specific questions within our employee engagement survey that are related to DE&I elements. We will also track participation and engagement throughout the enterprise in DE&I and events and training. All the items under talent we just discussed through the alignment from the recruit and retain objective. And all of the items under investment are aligned to the sustainable investment strategies under pension sustainability goal. And then all of the health equity measures are aligned to the exceptional healthcare goal. And then finally, supplier diversity. This measure will utilize data points from the participation in the supplier pool survey and the size of the pool. So with that, I will pause for any questions or comments.
I am not seeing any questions. I had a question though. The participation and results of onboarding survey. I find that interesting. What are we looking for?
So love to have our Michelle Tucker come in and provide any highlights, but the HR team has recently developed or in the makings of an onboarding survey that collects feedback through our hiring process. And there will be really key elements from that, those inputs that we'll be able to highlight here.
Okay.
And if Michelle wanted to add anything further, if she's there, or Doug.
It's fine.
I'm here.
Oh, there you are. I don't want
Hi.
to get people on that didn't think they were going to get on. So
No, I've been here waiting, so I'm happy to respond to that question. And thank you for that question. Hello, Michelle Tucker, CalPERS team member. Yes, so we have recently begun an onboarding survey, and this is through our Perceptics survey tool provider. So we use their question set, and it includes benchmarking for both onboarding, exits, as well as our annual engagement survey. So for onboarding, what we'll be looking at is how was the team members' quality of their onboarding experience? Did they feel welcome? Did they feel sort of rapidly introduced to our CalPERS mission, values, and so forth? And then we'll be able to sort that by various demography groups and look at different divisions. So what we're looking to see is that team members have a consistent, welcoming, inclusive onboarding experience, regardless of where they start or their own personal attributes. So those are some of the things that we're looking to measure and then to build upon.
Great. That's a great
Yeah.
idea. Thank you.
Ms. Taylor, the only thing I would add, thank you, Ms. Tucker, that was really good. It's just, these are the elements of early retention. So we go to all of this effort to recruit our top talent. This gives us early indicators of things related to onboarding, whether they feel welcome, whether they feel connected, and gives management an opportunity to intervene if we think there could be a retention issue ongoing.
Excellent. Thank you.
I see a hand up from Mr.
Miss-
Pacheco.
Yeah, Mr. Pacheco, go ahead.
Yep.
Thank you. Thank you very much, Madam President. I just want to make a comment that I really think this is, I just like this cultivating the diversity, equity, and inclusion through culture, talent, investment, health, equity, and supplier diversity. I think this is a really well thought out, well designed document. So I just wanted to make that comment. Thank you very much.
Thank you.
Thank you, Mr. Pacheco. Anyone else? Doesn't appear so.
Okay.
So I think we're done there. If that was the last slide.
Just one final slide to close out really and thank everybody for their time and support and input. Our goal is to have this wrapped up in spring to bring you back a final version and kick things off on time. And again, really appreciate your input and contribution to bring this plan to life. And it is really a living plan here at CalPERS. We do a lot of work to report our accountability and be transparent on a quarterly basis. So thank you for your input. And I see Mr. Miller's hand up.
Thank you, Mr. Miller.
Oh, no, it's him again. First off, just thank you. This is so well done and so impressive. And it keeps getting better, as we go along. I spend a lot of time looking at these type of documents from a lot of different organizations, and this approach and process is really refreshing. And the comment I have is more for the longer run. It's more the weeds, but we talk about engagement in a number of places, and it's very important. But also when it comes to member engagement or in particularly with healthcare, as we go along over the course of this plan and future plans, satisfaction and satisfaction member measures, in my experience, can be very one-dimensional and very difficult to figure out what they mean in terms of timely or actionable results. And if often the goal really is engagement there as well. And so just in the longer run, refining and thinking about how does satisfaction and distinct from satisfaction, dissatisfaction really relate to engagement vis-a-vis the customer experience. And I think back to our presentation from the Covered California and other folks where you can't necessarily tie customer experience to outcomes. And sometimes what our members want isn't really even what's good for them. And so how do we reconcile that? So how do we really think about that goal of engagement outcomes versus, top box measures on a survey or something? So something to think about, but just a big thumbs up for the work of the team and how far this has come over the last few cycles. Really impressive.
Yeah, thank you, Mr. Miller. And I know you have a lot of experience in this area with the Baldrige Award. So we actually look at this in two different ways. So the engagement side of this is really the participation rate that we get in the surveys. We like that, our last employee engagement survey was between 82 and 83%, which shows a level of engagement and a level of trust that when people give their input, that we'll actually do something with it. And then when we think about satisfaction, we try to find those things that we have mutually agreed upon expectations, right? So for the member, in the member instance, they should be able to expect, and we agree that they should have accurate benefits, that we should be responsive to them, and that we should be addressing their needs when they ask for them. So it's really around those mutually agreed upon expectations that we then can measure the satisfaction to those, and not expectations that we may not even know about. But that's our thinking behind this system, and hopefully that's represented well here. But again, look forward to any continued feedback that you would have or any other member of the board.
Great. And I want to also thank you all for this report. And it does show that as you brought it forward for us, that we got listened to. So we do appreciate it. And very good work. Mr. Fechner.
Thank you, Madam Chair. Ms. Hutchins, I just want to thank you and the team for all of the foresight that went into this. A lot of good information. Even though there weren't a lot of questions, that's because we understood what you were saying. So taught us over the time. So thank you very much for a great presentation to you and your team.
Thank you very much. They'll be so excited to hear that.
Excellent. Thank you, Mr. Fechner. Ms. Middleton.
What Mr. Fechner said, word for word.
Yay, thumbs up.
All right. It looks like I have no further comments or no hands are up. Okay. So now we'll thank you, Ms. Hutchins. Great report.
Thank you all.
Tell your team we appreciated it. Thank you.
Absolutely. Bye-bye.
So we will move on to 10C, summary of board direction. I don't think I gave you any, but.
I did not record any, Ms. Taylor.
Okay, great. So now we are on 10D, and that's public comment. And Mr. Fox, I believe we do have some public comment.
Yes, Madam Chair, we have one caller, Maureen Mendoza.
Go ahead, Marlene.
Hello, can you?
Yes, we can.
Oh, okay. Good afternoon, board members. My name is Maureen Mo Mendoza. I am an active state of California employee. I am speaking during public comment to make you aware of the problems with CalPERS when it comes to a parent with a disabled adult child to have their child remain on their health care, dental, and vision after they turn 26, which is the right of a state employee and their disabled child to receive. I contacted CalPERS in 2018 to find out what was needed to ensure that my child would remain on an active benefit that they are currently on. I filled out the necessary forms, and my son's doctor filled out the necessary part needed by the doctor to certify the permanent disability. The original forms were mailed to the address on the form. A copy was given to my personnel specialist in 2020 when I asked them if they had copies of the forms, and they informed me no. So I gave them copies that I had saved. I started receiving notices from my dental policy saying my child was going to be dropped from the insurance since he was turning 26. My personnel specialist was contacted, and they informed me they are not responsible for this, and that I would have to go through CalPERS. Since I began this journey, I have been so misinformed, and the lack of knowledge by CalPERS and the state employees in the personnel department has created so much grievance and anxiety for me. These are the changes that I feel are necessary to be done by CalPERS and the Human Resource Department so this process runs smoother and no one else has to go through what I have gone through. CalPERS policies and procedures updated on the process regarding disabled dependent benefits and on the CalPERS website. Your CalPERS website hardly has any information on what needs to be done. The second thing is the form HBD 34 needs to be updated to include not to be done before 90 days of turning 26. None of your CalPERS employees knew this, so I had started the process in 2018 and sent the paperwork in 2019. Same thing with the HBD 98. That form also needs to be updated saying 90 days. The state personnel specialists need to be trained by CalPERS in the understanding of the rights of a state employee with a disabled child and what the procedures are and who to contact. Also, they should be able to help the employee with this process.
Ma'am?
Yes?
I'm sorry, your time is exceeded, but could I possibly have someone contact you? For
Yes,
more information?
That would be great.
Okay,
Yeah, Ms. Taylor, we'll have someone from the health program just do a quick follow-up with her. But just as a reminder, our Pension Health Benefits Committee in March will have the parent-child relationship regulation for your approval.
okay, great. Thank you.
Mhm.
And thank you for calling. Are there any more callers, Mr.
Thank you.
Fox?
No, Madam Chair, that concludes public comment.
All right, thank you. I appreciate it. So that means that we are going to adjourn now into closed session for item 1 to 3 from the closed session agenda. This will include the following litigation matters: Wedding et al. Versus CalPERS, Kesterson et al. Versus CalPERS. We'll also receive the general counsel's update on pending litigation. And then after the closed session, the board will briefly report out into open session. So I will see everyone over in closed session, and we are currently adjourned. Thank you. All right, so we are now coming out of closed session. I have nothing to report. So that is the end of the day for us and the end of our open session agenda. So I will be adjourning open session and I look forward to seeing everybody in March. Thank you. Meeting adjourned. Have a good one, guys.